Without further ado, everyone, welcome to the live stream for Lemonade's Q2 2025 earnings call. It is early 5:06 a.m. for me. I have been so hyped for this earnings that I have not been able to sleep really well the last two nights. It's not because I'm nervous about earnings. It's just because I'm all in on this one company, right? So this is the biggest day for me of the quarter. And to be completely honest, as far as my investing job goes, as far as portfolio management goes, this is the one day of the quarter that I actually have to work. For my other business, like I have weekly meetings and stuff, but really, my strategy. Let's jump into this. But my strategy comes down to how do I make the most amount of money with the least amount of work, to be completely honest. I subscribe to Warren Buffett's view that oftentimes the more decisions you make, the more likely a higher percentage of those decisions are going to be wrong. Whereas if you only make a couple decisions, like all-inning on Tesla in 2019, with the help of some margin, helped me go from, $20,000 that I had saved total over that previous couple years to over $1 million. And now I think I literally only need to make, well, I've already made the one other decision my whole life in order to now become a billionaire, which was all-inning on Lemonade. So over the next 20, 30 years, I don't think I have to make another decision, and I will slowly become a billionaire. So this is so much easier. This is so much simpler from so many different levels, that I feel like not even I can mess this up. It's simple enough that it might actually work for me. So without further ado, let's get into this. Lemonade shareholder letter Q2 2025. Let me actually check the stock really quick. I just want to see if there's, yeah, okay. So on the drop, we're up 9.65% so far in pre-market. It looks like we spiked all the way up to almost 42 when this initially dropped. So just quick overview. Shai just tweeted out, thrilled to share Lemonade Inc.'s results for Q2 2025. 1.083 billion in in-force premium, 7th quarter of accelerating growth. They are now at 29% year over year, which is an acceleration. It should be over 30% growth for 2026 for next year. So we are slowly ramping into that. Loss ratio 67%, a 12-point improvement year over year. That is really big, guys. So if you have not analyzed insurance companies before, which I'm guessing is a significant, that's most investors, that's most people. Lemonade, to be fair, was the first insurance company I've ever analyzed. The loss ratio, you can kind of think of it like the cost of goods. It is the actual cost of the product that Lemonade is selling, which is the promise that if you have a disaster, they will cover it for you. So a loss ratio of 67% is really impressive. I'm sure there's going to be an image of the new loss ratio in the call, but if you look here, the trailing 12-month loss ratio over the last couple quarters, 88, 85, 83, 79, 77, 73, 73. So this is the cost of the actual product that Lemonade is selling, and now loss ratio for Q2 67%. So that's really, really impressive. Just more and more of the premiums that Lemonade is selling, they're not paying out in claims. So it means that the AI is getting better at pricing and accurately charging the correct premium. So generated 25 million of adjusted free cash flow. That's pretty solid there. Lemonade is not quite net income profitable yet. We will be fully GAAP net income profitable by 2027, which has been the guide for 4 years already. And I think we might hit it a little bit early, but we'll see. Gross margin up 14 points to 39%. Gross profit up 109%. Total customers up to 2.7 million. Revenue up 35% 25%. I believe the street was guiding for was expecting 33% revenue growth, so solid beat there. And here we go, raised full year guidance across in-force premium, gross earned premium, and revenue. Car loss ratio at 82%, a 13-point improvement, lowest since launch. And car and Europe growth engines are accelerating. Look forward, expecting 25 to be our second consecutive year of positive adjusted free cash flow, and expect to achieve positive adjusted EBITDA before end of year 2026, which is what they have been guiding for previously. Based off of the modeling that I've been doing, I think it's possible that, you know, we might see an adjusted EBITDA profitable quarter at the end of this year, maybe Q4. We'll see. It depends how much they spend on advertising. And I obviously want them to spend as much as they can. But if they wanted an EBITDA profitable quarter, you know, they could literally cause it to happen any quarter that they want by just spending a little bit less on growth. So, you know, X growth spend, they're already EBITDA profitable. So 29% increase in force premium, 4% increase in premium per customer, 24% increase in total customers. So now you can see the year-over-year metric of in-force premium, really solid, accelerating growth. Adjusted EBITDA and net income here. So this pink is adjusted EBITDA. Lighter pink is net income. So you can see, once again, we're headed in the right direction, right? So over the last several years, it has just been improving over time here. Now adjusted gross profit. Wow, 10%, 17%, 26% for Q2 2025. And then adjusted free cash flow. As you can see, we are now positive in free cash flow. So we will see Lemonade's cash balance grow this year. So let's hear what they have to say. Dear shareholders, our second quarter results were very strong. Oh, and just so you guys know, for anyone who is watching, I'm guessing the earnings call will probably be let's see, actually we don't even have to guess. I think they say, yeah, so it'll be at 7 a.m. my time, which is about an hour and 45 minutes from now. So we're going to take our time on the shareholder letter, and I'll stay live, and we'll listen to the earnings call here live as well. So dear shareholders, our second quarter results were very strong, once again headlined by accelerating growth, healthy underwriting performance, and excellence in expense management. The quarter saw momentum continue to build in two of our high potential growth engines, car and Europe, which we'll dive into in a bit more detail. Looking ahead, we have raised full year 2025 IFP, GEP, and revenue guidance while reiterating full year 2025 adjusted EBITDA guidance. All right, here are the key metrics. I'm guessing there might be a little bit of overlap here between Shai's post, but that's totally okay. Hey, Neil, I see you guys in the chat. Thanks for doing the stream. You guys are totally welcome. Do I hold options, or am I just long? I'm 100% shares. I am 100% shares. I am using a little bit of margin, but I prefer owning shares straight up because there's no time requirement on you know, predicting when something's going to happen. I only have to predict that it is going to happen. So top line, in-force premium at 1.08 grew 29% year over year, our seventh consecutive quarter of growth acceleration, while revenue grew 35%. And we're going to see this revenue acceleration. It's going to, you know, we're going to be seeing 50%, 60%, 70% revenue growth quarters, I think, over the next 12 months. But we'll look into the guide and see if I'm right. Loss ratio, trailing 12-month gross loss ratio improved by 3 points sequentially to 70%. Okay, so trailing 12-month loss ratio. So looking at this next quarter, 70%, baby. We just dropped another 3%. That's really solid because remember, the trailing 12-month loss ratio includes the California wildfires in Q1. So even including the California wildfires, which caused a flat quarter over quarter trailing 12-month gross loss ratio in Q1. It's still in part of the trailing numbers, but because remember just Q2 was 67%, that causes trailing 12-month gross loss ratio, even including California wildfires, to now be 70%, which is so good. That is really, really good. We're going to be mid-60s, guys. We're going to be mid-60s here really soon. Comfortably in line with our target. Our second quarter gross loss ratio of 67% was 12 points improved relative to the prior year, and way more than that quarter over quarter. Gross profit increased by 109% year on year to 64.3 million, while gross margins improved 14% to 39%. How's the stock reacting right here? So yeah, it looks like we're still up about 7% in pre-market. Operating expenses, 83% increase in growth spend. Operating expenses grew much slower than revenue. In growth spend, consistent with our accelerating growth plan, excluding growth spend, operating expenses declined by $1 million or 2% versus the prior year. That's crazy, guys. I do not think people appreciate what it means that Lemonade is really the Netflix of insurance. People have been wanting to say HIMSS is the Netflix of healthcare, but HIMSS doesn't have AI. HIMSS does not have a scalable platform in the same way that Lemonade does. Lemonade can add customers without adding employees because AI is selling 97% of policies. AI is instantly fulfilling over half of claims. AI is doing over half of customer support tickets. AI is doing internally human relations for the company, or HR. AI is doing IT, like with Loco, which I hope we'll hear about. AI is literally doing regulatory filings and, launching the product in new states, with no coding required. So having a fully autonomous platform allows you to have crazy numbers like this, where you are growing revenue 35% year over year and decreasing operating expenses, excluding growth spend, by 2% year over year. Like, guys, that's crazy. That's operating leverage that literally destroys the traditional laws of business and finance. So, we've never seen this before, okay? We have never seen this before. It's really, really exciting, and people tend to underestimate things that have not happened before, right? So people will still say, Lemonade's expensive compared to traditional insurance companies, when, they're not thinking about the fact that Lemonade's going to have an expense ratio that's 1/4 or 1/5 of what a traditional insurance company's expense ratio is going to have, better underwriting and more accurate pricing than any insurance company has ever had, for lower loss ratios than any insurance company, ever averages. So besides the fact that, insurance is a slow growth industry, it's growing like 3, 4, maybe 5% a year. And Lemonade's growing, just put up a 35% revenue growth number. So Lemonade is very cheap, in my opinion. Not financial advice. I am someone who is all in this company. So also understand I have bias, but I went all in because this is crazy, that you can grow revenue 35% while reducing operating expenses, while continuing to increase your Trustpilot reviews. So it's like you're automating stuff while customers are happier at the same time. Bottom line, adjusted EBITDA loss of 41 million was 5% improved relative to the prior year, in line with our guidance. Remember, we're going to be getting adjusted EBITDA profitable next year for the first time, which is exciting. Net loss in the quarter was 44 million, 23% improved relative to the prior year. And guys, the reason why these numbers are not far more insane is because, you have to remember that there was a 93% increase in growth spend. So just keep that in mind. the actual operating leverage of the business is insane. Okay. Cash flow generated 25 million of adjusted free cash flow in the second quarter, an increase of 23 million relative to the prior year. Cash flow from operations was 6 million in the second quarter, an increase of 17 million relative to the prior year. So even if you don't adjust it, guys, even if you don't adjust the free cash flow, we have positive. I believe this is the first non-adjusted positive cash flow quarter, at least cash flow from operations. An increase of 17 million. Okay, let's look at some charts here. So IFP growth. So this is the accelerating IFP growth. And this acceleration is really exciting. So the reason why, if we look at HIMS right now, like HIMS just put up a pretty solid growth number, HIMS stock, but it's down 13% in pre-market. Why? Well, it's because their growth started decelerating, and the deceleration is going to continue, so that by Q4 of this year, HIMS is going to be looking at 30% year-over-year revenue growth. And over the next 5 years, HIMS management is guiding for like 22% revenue growth. So we're going from 117% revenue growth year over year in Q1 to only 30% revenue growth year over year by Q4 of this year. That deceleration the market does not like. The market does not like when a company starts growing slower and slower and slower. It's going to take a lot of the wind out of the sails. But you compare that to Lemonade, Q3 2023, 18% growth, Q4 20, 22, 22, 24, 26, 27. Now we just put up 29%. So every single quarter, we're not just growing, we are growing the speed at which we're growing. So every single quarter, we are growing faster than we grew the quarter before. So that is what is really, really exciting. The 7 quarters of IFP growth acceleration alongside this trailing 12-month gross loss ratio, which here's the brand new chart. I got to tweet this out here. Let me take a screenshot of this really quick, because that's really, really sexy. Trailing 12-month gross loss ratio. Save that image. TTM, GLR, LMND. All the acronyms. All right, and then let me just post this really quick. A thing of beauty. I can spell, guys, don't worry. LMND, and then we get the new chart right here. All right, cool. Let's keep going. Let's keep going through this. If this trend continues, actually, like if we're getting like a 3-point decrease in Q3 and then another 3-point decrease in Q4, we will already be at 64% trailing 12-month gross loss ratio. This is the type of gross loss ratio then where Lemonade hits adjusted EBITDA profitability a year ahead of schedule, just like they hit adjusted free cash flow a year ahead of schedule. Okay, in-force premium versus operating expenses excluding growth spend. So this is insane. Look at that. So Q3 of 2022, 87 million of operating expenses excluding growth spend. Q2 2025, which we're now looking at almost 3 months later. 3 years. Next quarter, it will be 3 years later, 23, 24, 25. And we are at 7 million less operating expenses, excluding growth spend. And then this is top line. That's crazy. Sustained operating leverage driven by AI and automation. And when people you can't look at this. You can't look at this and then say, prove that Lemonade's using AI. Like, well, how do you know that they're better? It's like, look at the freaking numbers. This is insane. If this can continue, I don't know how long this can continue for. Like, can we see $2 billion in premiums and still, under 100 million in operating expenses, excluding gross spend, like that will be crazy. If this can continue, that will be crazy. All right, Lemonade Car update. This is big. So Lemonade Car is going to be a substantial driver of Lemonade's 10x from 1 billion to 10 billion in IFP that Lemonade laid out in their 2024 Investor Day. Car delivered another quarter of growth acceleration, concluding a very strong first half of 2025. Our Q2 in-force premium result represents 12% sequential growth, outpacing the overall business for the second consecutive quarter. We expect more of the same in the coming quarters. So I believe this is 12% quarter over quarter from Q1 to Q2. Car grew 12%. That's crazy. Last quarter, we discussed, which is faster than the rest of the business overall. Last quarter, we discussed experiments incorporating telematics insights earlier in the customer lifecycle. These and similar tests yielded a 60% boost in conversion rates in Q1 as compared to our Q4 baseline. So this was really kind of overlooked here. A 60% boost in conversion rates is crazy. If you've ever run an e-commerce business, which I have, if you could boost conversion by 16%, that's a game changer. So that happened in Q1 compared to Q4. In Q2, we began investing behind those learnings, increasing our car growth spend by 25% as compared to Q1 while maintaining marketing efficiency levels. Geographic expansion has been another growth tailwind. Colorado, launched in Q1, has delivered encouraging performance. We have seen higher new business and cross-sale conversion rates in Colorado's first full quarter than in any prior state launch. Indiana launched on July 7th. We're eager to see it develop along a similar trajectory. All right, I am seeing some great comments here. Just take a quick second to see what you guys are saying here. I've been awake all night. Yeah, I totally feel that, man. It's exciting. Okay. Yeah. Yeah, the people on Amit's channel that have been trash talking Lemonade ever since we did the deep dive there, it just doesn't really matter. The numbers prove themselves and people will wake up in time. Okay, our Q2 car gross loss ratio was 82%, 13-point improved versus the prior year, and the lowest since we launched car. We are seeing favor. So just so you know, guys, like an 82% loss ratio is something that like a traditional insurance company would run at as their average, forever. And this is going to continue dropping. This was a 13-point improvement over last year. And this is really exciting. I think that Lemonade is going to be able to price car more accurately than anything else because they have more data than in pricing anything else with telematics. So I have a feeling car is going to be far more successful than even the bulls are currently predicting. This strength, delivered concurrently to growth acceleration, illustrates a critical pillar of our strategy. Broad telematics adoption yields enhanced pricing segmentation that allows us to evaluate risk with precision, driving down both prices for good risks and loss ratios. Car growth acceleration and loss ratio improvements. So gross loss ratio is this pink line, and then in-force premium is the gray. So you can see that during this experimental phase here, Q1 2024 to Q4 2024, this whole previous year, car was in the testing phase, right? They're iterating on the product. They're making sure they're training the algorithms to be able to underwrite accurately, and they're not really increasing their in-force premium for car because it's bad, right? To add more customers that are going to have a bad loss ratio. It's going to hurt your business. But now you can clearly see from Q4 2024 to Q2 2025, this in-force premium is starting to really accelerate. We've seen, from Q3 to probably Q3 of next year, it's going to be a 50% growth. In a little over one year here. So this is really exciting. especially when you see the gross loss ratio coming down concurrently with IFP going up. That's exactly what you want to see. That's exactly what you want to see. Okay, second spotlight. So 2 spotlights in here. Not only a car spotlight, I guess it was a car update, and then now a Europe spotlight. A lot of people have been curious, what's happening in Europe. So let's see what's happening. Our European business is already contributing meaningfully to our growth. We're live in Germany, France, UK, and Netherlands, serving 250,000 plus renters and homeowners. And just so you guys know, when we look at a stock like Progressive, so this company worth $141 billion. Compare that to Lemonade, which is currently worth $2.7 billion. So, that's a lot more. 141 billion compared to 2.7 billion. This company is pretty much only car insurance, and it's pretty much only in the US. And it's worth $141 billion. Okay, Lemonade is already far more diverse in that, we just saw cars ramping up really nicely. It's expanding across new states. But Lemonade is also, number 2 in pet insurance right now, on the way to number 1 in pet insurance, which is probably one of the fastest growing insurance segments. They are dominating renters insurance. They are growing now really fast in car insurance. Plus, Progressive is only a US company. Lemonade is already in Germany, France, UK, and Netherlands with 250,000 plus renters. So the TAM for Lemonade is so much larger than the TAM, which stands for Total Addressable Market for Progressive. And the company is tiny at only 2.7 billion. That's why when I say like Lemonade can easily 100x to, like a $300 billion market cap, it's not crazy. It's like they can have smaller market share than Progressive, but because they're in so many different insurance segments and countries with a smaller market share than Progressive, they can have twice as large of a market cap. And Lemonade can be less dominant than Progressive in car, which I think they'll be more dominant than Progressive in car eventually, but they could be less dominant than Progressive in car and still be a 100x company. All right, we are currently up 9.46% in pre-market, which is looking good. And for anyone who's just joining, I'm going to be live until the earnings call here, and we will be listening to the earnings call live on this stream. We are live on X and YouTube. We currently have 81 viewers on YouTube, and let's see, 1.3K viewers on X. So X is destroying right now, baby. Okay, let's get back here. So Spotlight, Europe. So 250,000 customers. Europe diversifies our growth opportunity beyond the US with lower catastrophe exposure and a regulatory environment that enables rapid pricing and underwriting iteration. So it's a diversification of regulation. It's a diversification of catastrophe exposure. And it sounds like they can rapidly iterate on pricing faster in Europe, which is very interesting. Since Europe is generally a lot more regulated. This accelerates feedback loops, sharpens our AI-powered models, and enhances pricing accuracy. Our AI-native platform scales across markets spanning languages, products, and regulators, with no need for large local teams and country-specific infrastructure. This yields a structural efficiency that enables us to deliver attractive prices to customers. And you might ask, like, how come none of the 200-year-old insurance companies, why are more of them not international companies? Well, it's because for a Progressive, if they want to launch in Europe, they have to hire people in Europe. They have to launch offices in Europe. Lemonade doesn't have to do all that because they're online, because they're AI run. It's just, much cheaper. The fact that, they can lower operating expenses over a 3-year period, while, what is it, tripling customer count or something? It's crazy. I think that's not quite triple, maybe double. The result, in Q2, Europe in-force premium grew over 200% year over year to $43 million. That's pretty good. You guys think that's good? 200%, over 200% year over year, to 42 million, contributing over 20% of Lemonade's net new customers. This has been paired with gross loss ratio improvement. Q2 landed in the low 80s, 15 points improved year over year. Okay, so this is growth rate. This is not loss ratio. Don't get confused, because here, obviously, when the pink line is gross loss ratio, we want it going down. When the pink line is growth rate, we want it going up. So you can see a similar accelerating growth rate in Europe. And yeah, a 200% increase year over year is not bad. Is not bad for Europe, year over year growth. Okay, and then loss ratio is still a little bit higher than the average book, but a 15-point improvement means that it's improving faster than the rest of the book. So that's really exciting. Compared to when we crossed $50 million in in-force premium in the US, our European business has a gross loss ratio over 20 points better and delivers double the amount of new business per dollar of gross spend. Wow. So Lemonade's overall CAC to LTV, which is customer acquisition cost to lifetime value, is 3 to 1. So for every $1 that they spend on growth, they are getting $3 in profit. This is not revenue back, $3 in profit back over the lifetime of that customer. And that's overall. So if Europe is getting double the amount of new business per dollar, then I think we can, safely assume that's an LTV a CAC to LTV of 6, which is crazy. Looking ahead, we see rich potential, deeper penetration in existing markets, new product launches, and stronger cross-sell focus. We believe that Europe will continue to be a key engine of rapid, 200% growth. Do you want more rapid than that? Profitable growth for years to come. So this is really exciting. This is so exciting. And it's something that a company like Progressive, they've been around for 200 years, and I guess they'd never even thought to expand to Europe yet. Someone should tell them that it exists. I'm just kidding. I'm just joking. Okay, so that's really solid. All right, now reinsurance renewal. So for those of you guys who do not know, Lemonade announced that they are dropping reinsurance. My green screen is so terrible. I apologize for that. But they are dropping reinsurance from 55% of total premiums they were reinsuring to now only 20% of premiums they're reinsuring. So what this means, if you guys don't know, Lemonade has over $1 billion of IFP. But if we go look at Lemonade's revenue, so let's see, Lemonade revenue macro trends. If we look at Lemonade's revenue, it's not going to show 1 billion.08, which is the IFP they just put up. Trailing 12-month revenue, it only shows as 559 million. You see here, 0.559 billion. So 559 billion is what everyone who looks at Lemonade, they're like, oh, okay, yeah, growing revenue 26%. This doesn't show the most recent quarter. Right? I think this is Q1 that it's showing here, so it's not showing Q2 here. But people look at this and they're like, oh wow, 559 million of revenue, and the stock is 3 billion. That's a pretty high price to sales, and what they don't understand is that half of Lemonade's current premiums, half of Lemonade's current $1 billion in premiums, they cannot yet count as revenue. It's not counted as GAAP revenue yet. So this reduction of reinsurance from 55% to 20% unlocks 25% of Lemonade's total premiums as new revenue over the next 12 months. So we're about to see a 30% in-force premium growth over the next 12 months, plus a 25% which will be about $250 million of additional revenue unlocked from reducing reinsurance. So, we're literally probably over the next 12 months, we'll see what they say here, percent revenue growth over the next 12 months. Just because of this one reinsurance change. And for anyone who doesn't understand Lemonade, they're just going to see this number in 12 months go from 0.559 to 1. It's literally going to go up to 1 billion, over the next 4 quarters here. So it's really, really exciting. So let's see what they have to say here. We recently announced the renewal of our reinsurance program for the year starting July 1st, 2025. We renewed coverage with a panel of long-term partners on terms materially changed, with one notable difference. We reduced the proportion of quota share program from 55% to only 20% cessation, right-sized for a book at our stage of maturity. It's worth underscoring that this decision was deliberate. We had a wide range of options available to us, including renewing on the expiring terms. By reducing premium cessations related to quota share reinsurance, we keep more of the business on our books, thereby retaining more revenue and gross profit. This is a free unlock. Normally when a company accelerates revenue growth from, 35%, which it came in Q2, to, potentially we'll see what they guide to, but, maybe 100% over the next 12 months. Normally, an acceleration of growth comes with a reduction in profitability because you have to spend way more for that growth. You're stretching a bit to try and grow faster. So that means that you're maybe getting a lower return on your spend, that sort of thing. This is the complete opposite. We are going to see more revenue drop to the bottom line, retaining more revenue, and we are going to see the profitability of Lemonade's revenue increase at the same exact time, because this increase of revenue actually reduces expenses. Because, when Lemonade reinsures 55% of their policies, the company that they're paying to reinsure is now getting a percentage of the profit. They're splitting the profit, essentially. So when they keep all the risk themselves of this 35%, wait, was I saying 25%? It's 35% reduction. They keep more revenue and they keep a higher percentage of the profit for that revenue, assuming that this trailing 12-month gross loss ratio continues to go down, which they're kind of guiding that it is. It will continue to decrease here. So it's really bullish in a lot of different ways. And I don't think people understand it because most people don't understand insurance. But pretty much the reason it's so bullish is even people that don't understand insurance are just going to see this, this growth accelerated a crap ton. They're not going to know why. And they're just going to think it's so cool because, it is exciting. So it's going to make everyone who currently thinks Lemonade is bad all of a sudden think it's incredible. And they might not know, quite why, but it's going to look like Lemonade's, one of the fastest growing AI companies in the public market. Okay, our ability to make this move now is thanks to our consistent multi-year track record of improving loss ratios and more predictable underwriting performance. A couple of important clarifications. A lower quota share reinsurance cession would typically increase capital needs and reduce capital efficiency within our regulated insurance subsidiaries. However, an improved loss ratio and the expanded use of Lemonade RE, our wholly owned captive, offsets these pressures such that there is no material change in our capital plan. Okay, that's really great. Premiums ceded to reinsurance partners lead to a proportional reduction to revenue, but not in-force premium. Therefore, a reduction in our quota share program increases our revenue retention and yields a period during which revenue growth rates are expected to outpace IFP growth rates. Yes, exactly. And that, that's put lightly here. All quota share coverage is on a risk attaching basis, meaning it covers policies written or renewed between July 1st and July 30th. As such, the transition from 55% to 20% ceded does not happen overnight. Okay, so this is important to keep in mind. We're not, going in Q3, we're not going to see 100% of the revenue all of a sudden. Rather, Ceded earned premium related to our quota share program as a percentage of gross earned premium is expected to gradually ramp down from 55% to 20% over the next several quarters in a roughly linear fashion. This dynamic is embedded within our 2025 revenue guidance. Okay, so let's look at what the guidance is. This is where he gets excited. Please reference the insurance supplement at the end of this letter for more details. Okay. Below, we note how we expect the third quarter and full year 2025 to shape up. We have raised full year in-force premium, gross earned premium, and revenue guidance while reiterating full year adjusted EBITDA guidance. Revenue guidance contemplates the impact of the recent reinsurance renewal and reflects the gradual transition dynamics noted above, such that the expected share of gross earned premium ceded to quota share reinsurance partners is expected to be 45% in the half two of 2025 in aggregate. Okay, so we're only going to see a 10% reduction here in the second half of 2025. And then this is going to, linearly continue over the first half of 2026. We reiterate our expectation of positive adjusted free cash flow for full year 2025 and expect to realize positive adjusted EBITDA before the end of full year 2026. So in Q3, they are now expecting 1.14 to 1.144 to 1.147 in IFP, gross earned premium to be 267 to 269. Revenue 173 to 186, and then adjusted EBITDA loss of 37 to 34 million. And then now for the full year, gross earned premium 1.2, and then here we go, revenue 710 to 715 million. Okay, so let's see here what this means for revenue growth year over year. So Lemonade revenue total 2024. Okay, so 526. Let's pull up a calculator real quick here. This is probably not the most efficient or effective way to do this. 1.4. Oops. 1.4 is what I want. So 736. Okay. So it's not quite going to be 40% revenue growth for the year, but it's going to be close. 1.35. Yeah, 715. So this is the low end here. So it should be over 35% revenue growth for full year 2025, accelerating right into Q3, Q4. We'll be accelerating revenue growth, and then we'll have to see what full year 2026 is. But it's gonna be, probably just off the top of my head, if I had to guess, 60-70% year over year growth or something in 2026 maybe. Okay. Stock-based compensation expense and weighted average common shares unchanged. Okay. So there we have it. So this is going to probably restate a lot of what we were already looking at here. But maybe I should take some time here to respond to some questions. It's probably going to be, I think it's going to be an hour still. Let me see here. 7 a.m. So an hour and 10 minutes. Until the earnings call starts. So we're going to have a bit of time to chat here. But let's just quickly make sure there's nothing new here. So IFP 29, yeah, that was already covered. Customer count 24% covered. Premium per customer up 4%. Annual dollar retention. So ADR is 84%. Just so you guys know, I was actually working on a tweet. I didn't finish it. But an average dollar retention of 84%, this is annually. This is so much better than, like a company with a subscription business model in another market like HIMSS, for example, in healthcare. I believe HIMSS let's see. HIM's quarterly churn rate. Yeah, so 85% churn. Even if we said 90% churn, we just took the middle here of whatever this AI answer is, of 90% churn, that's over 3 months. So over an entire year, HIMS is going to have far worse churn than Lemonade, because this is a 1 year churn of 84% retention. So that's a churn of 16% of premiums. So 16% of Lemonade's premiums are churning over 1 year. This also includes like Lemonade chosen non-renewal to increase profitability. So I believe like 1/3 of their home churn over the last 12 months was literally Lemonade deciding to non-renew. But even with that, Lemonade is looking at an annual churn rate similar to HIM's quarterly churn rate. So that means every quarter, HIMS needs to add back, the same amount of customers just to stay flat in customer count as Lemonade needs to add over 4 quarters. And it also means that, if HIM's churn is around 84% or 85% over a quarter, you're looking at like almost half of your subscribers churning over a year, which is way worse than Lemonade's ADR retention, annual dollar retention of 84%. Now, I should say this isn't exactly fair, because some current customers are obviously going to upsell, right? So if some customers are buying a new car and adding a second car, or bundling home or something like that, that will also increase annual dollar retention. So this probably does hide some of the churn, just because you have current customers that are also just buying more and more, which makes annual dollar retention look better. So it's not quite fair, but I think it's very fair to say that Lemonade probably has a much higher retention rate than a company like HIMS, even considering those factors. Gross earned premium. Yeah, we looked at this already. Revenue up 35. And this is just, this is going to be accelerating, because remember in Q1, the revenue growth was quite a bit lower than this, I think. Let's look at here. So in Q1, so in Q1, revenue growth was only 27%. So if Q2, we're looking at 35% revenue growth, it's already accelerating, and we really haven't even seen the insurance renewal, tailwind kind of hit. And they're already guiding for now 35% growth for the full year. That means that in Q3 and Q4, we're probably going to see above 35%. Potentially Q4 might be like 40% revenue growth year over year for the full year to hit just north of 35%. All right, gross profit up 109% year over year. Thanks to the 10-point improvement in the net loss ratio. Okay, yeah, we've covered all of this. All right, so that is the shareholder letter. Let's go back to X and see what everyone is saying here. Can I see live comments? Let me see here. I don't know how this works. Okay, comments, chat. So I can go over if some of you guys want. I'm guessing many of you are already quite familiar with Lemonade, but I'm happy to go over whatever you guys want in the next hour and 5 minutes until the earnings call starts. So I can't actually see any messages here, so I'm not sure if this chat works. But let me look on YouTube here. Reinsurance to zero soon, says R. Lee. I don't know if it will ever go to like absolute zero, but it will keep decreasing. Yeah. Because it sounded like, so this is one thing that I think might have been easy to miss here, but Lemonade set up their own reinsurance arm and they're reinsuring for themselves in order to not have to hurt their, oh, I'm in the wrong shareholder letter. In order to not hurt their capital requirements, they set up Lemonade Re. So the expanded use of Lemonade Re are wholly owned captive. So Lemonade Re, they can reinsure their own policies themselves, keeping all of the profit and risk. Yet it still impacts the capital needs, the regulatory capital needs. So that's very interesting. They're having kind of their own reinsurance arm. Maybe that does allow them to eventually go to like 0% reinsurance, because they still are using some, but just they're using themselves. So interesting point there. Hello, Fatty Zone, how you doing? Lemonade up 10%. Oh yeah, let's see how the stock's going. Yeah, so pre-market, things are looking really, really nice. That's crazy. You know, I have over 100,000 shares of Lemonade. So a $4 move is quite a big move in the pre-market. So we'll see. We'll see how. I have no idea how this is going to end. But you have to keep one thing in mind for Lemonade, which is that it is one of the most shorted stocks on the entire market. So the short interest represents over 30% of the float. So short percentage of float is 30%. So if we see a short squeeze today, like if shorts cover today because of this guidance, because the loss ratio is looking insane. I mean, the fact that in Q1, you know, operating expenses were up slightly compared to Q3 2022. And then you go over now to Q2 and they look at this. 89 million operating expenses Q1, excluding gross spend. Q2, 80 million. Like, how good is that? So now we're down 7 million in 3 years of operating expenses while they're scaling like this. So if we see a short squeeze from this, it could be crazy. It could be a crazy day. It could be a really crazy day. Now, that said, I don't play options. I don't feel confident in my ability to predict how the market will react to news, because like the way I think about this, sometimes you get really good news and the market reacts negatively. And it's like, oh, I was right that the news was going to be good, but the market reacted negatively. And then other times you get bad news and the stock goes up. So I think predicting short-term movements is really difficult, because you're not only predicting whether or not the news will actually be good or bad, but then you're trying to predict how the market is going to then react to that good or bad news, which I just think is really difficult. I think it's so much easier to become a billionaire with long-term investing, where you just make one decision and then you don't have to make another decision for 30 years. And eventually the stock price just follows the fundamentals. And it's just so much simpler. You take out the headache and then you still get the excitement of, you know, having over 100,000 shares in a day where the stock goes up 10%, and it's just like super great. But we'll see. Could the stock finish down today? It would be insane if that happened, but I have no freaking clue. I have no freaking clue what it's going to do. So if we do pull back maybe to like 38.70 again, I might deploy a little bit more margin. I might do that, because this is just all such great news overall. And yeah, if the market wants to go down today, I will be so freaking happy. I'm sorry for anyone who's playing call options or something, but if the market wants to go down today on today's earnings, you know, we're up 7%, so it's probably not going to happen. But that would be a gift. That would be one of the greatest gifts of market inefficiency that could ever be given to anyone who's paying attention. It is still very low volume, so keep that in mind. Before hours volume is only 73,000 shares. So, you know, hardly any shares have traded so far. So I wouldn't read too much into this reaction. When the market opens, that's going to be really like, that's when we're really going to say, you know, how the market wants to react to this earnings. But I do expect we're going to get, you know, probably, you know, we could easily get several million volume once the earnings call starts here, which is now T-minus 59 minutes. So we are officially under an hour. Let's see what the community is thinking about this here. Let's head over to Lemonade. Oh, wait, we had a post from Daniel here. Yeah, Daniel's happy about this one. But let's see here what people are saying. So let's sort by most recent. Next hurdle in 5 minutes, 7 a.m. New York time. Okay, yeah, so that just happened. So at 7 a.m., okay, so this is why we're seeing a slight sell-off from Wall Street waking up. Who cares? They don't know anything. They truly don't know anything. They know some stuff, but I tend to fade their decisions. So yeah, this is a great, so incredible. In this post, I shared that Lemonade should at worst be trading at 166. So let me actually show you guys my model real quick. I'll show you my model. Drive. I'm going to open this up and then I'll pull it over for you guys. Just so you can see kind of what I'm expecting over the long term for Lemonade, because this is obviously like a really exciting quarter. But what is, if we zoom out, how does this quarter play in? So first of all, this quarter beat our own expectations, just to be completely clear. This quarter beat all of my own expectations. Oh no, all the charts are stacked right now. Okay, actually this is the old one. Sorry. One second, guys. Technical difficulties. Okay, we actually won't show the chart then. We'll just look at some of these expectations. All right, I'm going to pull this back over so you guys can see it. Okay. And I'll zoom in a bit here. Okay, you fixed it? Okay, I see. My brother's saying that we can get it fixed with a refresh. Okay, so this is looking at our market cap expectations. This is the S&P 500. This is HIMSS here, and then this is Lemonade. So our expectation for HIMSS is a $15 billion market cap in 1 year. We're being quite conservative for Lemonade here. But now you can see 5 years, we're going to 16 billion. 47 billion for HIMSS. For Lemonade, 56 billion, 123 billion for HIMSS. 20-year, 200, and this is looking. I think Aaron just changed all these numbers to be far more conservative, because this was showing over 100x a minute ago. Oh, also this updates in real time, right? So if the stock's up 10%, that changes the 20-year ROI quite a lot. So if we take those market caps and translate them to returns, you know, we're in 5 years, we're expecting a 3x on HIMSS, a 6x on Lemonade, in 10 years, an 8x on HIMSS, a 20x on Lemonade, and then 20 years, a 35x on HIMSS, a 77x on Lemonade. So let's switch over to the chart side here. And just so you guys know, by the way, I expect our models to be wrong, okay? The goal of our models is not to correctly predict what's going to happen 20 years from now. The goal of our models is to see directionally if trends are going to continue as they have been. And for Lemonade, it's just so freaking easy because they've literally guided for 30% revenue growth over the next 7 years, over the next 10x. So they've just given us such a long runway of guidance, so we can. It's very easy to guide out a long time. But the goal of this is to kind of just have a general idea. So when we run our model over 20 years here, so this is a 20-year expected ROI, I don't expect this to be right? Like it could be a 200x, it could be a 50x. But what I want to see is how Lemonade, based off of what I currently understand, how Lemonade does compared to other stocks based off of what I currently understand. And you can see that Lemonade, the next highest is HIMSS here for our expected ROI. Lemonade has more than a double expected ROI over HIMSS in 20 years. And then you can look down here like Tesla 17x, for Shift 4 23x, Biostim. We'll see. This is a very small speculative company. So I also feel the most confidence in Lemonade compared to these others. So not only is it the greatest return expectation, but I also feel the most confident about that return over 20 years. And that's why I'm all in Lemonade. It's just too clear, too obvious not to be. And like I said, this is what Lemonade just put up, beat all of our expectations. Okay, let's see if Paperbag has shared any of his thoughts here. Let's see. I will share thoughts in this thread as I process the letter. Okay, so he hasn't shared anything yet here. But I would love to hear Paperbag's thoughts soon as well. But yeah, overall, an incredible quarter. Let's see. Arlie is saying the stock is up 12% now. Okay, no, that was a minute ago. So we're still hovering about 8% up in the pre-market. Okay, let me share some of kind of just my general thoughts. There's a lot of people watching this right now. It looks like across YouTube and X together, we have nearly 3,000 people that are watching this stream, and I'm guessing that most of you guys don't actually, like, you might not know that much about Lemonade. You might not have been following it super closely. So I just want to go over quickly here in the next like 42 minutes until the earnings call starts. Just some like general points of background, kind of just like lay out the case in simple, straightforward terms about why I'm so bullish on Lemonade. Like, okay, it's great, you know, to show you this thing like, oh, I expect Lemonade to 77x in 20 years, but why? Like, what's my thesis? I need to be able to explain this. I'm a really big fan of Peter Lynch. I view him as my investing mentor. And one thing that he said that I think is just really, really great is that, well, first of all, investing is not that complicated. You only need fourth grade math. But second of all, your thesis should be simple enough. The reason that you are invested in something should be simple enough that you can explain it to a child with crayon and they can understand it. Okay. If your thesis is not simple enough that a child can understand it, then it's probably, you know, too complicated. It might not work out. So I think the Lemonade thesis is quite simple. And just really exciting. So just a couple points of background. The first one I want to get into here is that Lemonade is like an AI first company. So something like this, let me exit out of the Q1 so I accidentally keep clicking to it. Something like this, where you have operating expenses dropping by $7 million, which is, you know, about 10% over a 3-year period, while your top line almost doubles. This is the sort of thing that a normal insurance company could never do, right? Progressive, I think Progressive hires 12,000. Progressive needs more humans based on the number of customers it has. Why? Well, because when Progressive adds a customer, that customer is going to need support. And Lemonade gives these customers support with humans. So in 2025, Progressive is hiring 12,000 additional people. Lemonade only has 1,200 people total. So Progressive is adding 10 times the total number of people that Lemonade has just in 1 year of hiring in order to support the company's growth. Lemonade, as an AI company, reduces operating expenses while doubling. Okay, this is something that an insurance company cannot do. And that's why I say Lemonade is an AI company. And they decided to sell insurance because it's worth 8% of GDP. It is literally one of the biggest total addressable markets on the entire planet, on planet Earth. And it hasn't seen innovation in hundreds of years. These insurance companies are old. Let's see, how many insurance companies are over 200 years old? This means that they were started in the 1800s. So you have Lloyd's of London. Okay, these are looking at some quite old ones, but these are still active, right? Founded 1688, founded 1710, founded 1752. When was Geico founded? Geico is going to be one of the most new insurance companies, actually. 1936. Okay. Did the internet exist back then? No. Right? Did AI exist? No. So Lemonade is built, was launched as an AI company because the founders said, hey, this entire industry is automatable. Like every single role within insurance can be automated. It's fundamentally different than any other insurance company because it is an AI company. And yeah, it's ripe for innovation. So why would an AI company want to sell insurance? Fully automatable, worth 8% of gross domestic product, ripe for innovation. The second thing that I want to talk about here is the founding team. Shai, if you don't know, let's give him a quick Google here. Shai Wininger was the founder of Fiverr. So I think Fiverr's worth about $1 billion right now. I actually think Fiverr might be super undervalued, actually. How do you Fiverr stock? I think it's just 2 R's like that. FVRR. Yeah. So okay, it's only worth 800 million right now. So it's trading at a 44 PE ratio, but I think. So I know this is a Lemonade call. Fiverr is the company that Lemonade's co-founder started before Lemonade. So we're just giving you some background here. But yeah, okay. So a forward PE of 8 is quite low. I think Fiverr's gross margins are like 81% or something. And it's trading 2 times sales, less than 2 times sales. So that's crazy. I think this company is super undervalued. Yeah, wow. It was $300. Now it's 21. And oh my gosh, look at that chart. Is this not a perfect buying point for Fiverr? Okay, I need a, but this is the Lemonade. But look at that freaking chart. We bought him here once, twice. Okay. Anyway, he started Fiverr, very successful, super technical guy, really, really smart. He is kind of the tech genius behind Lemonade. You also have not Shai Wininger, that's Daniel Schreiber. Daniel Schreiber, who is another very successful founder in his own right as well. Who I believe was mentored. He sold his last company to SanDisk, which is a really big company. I think SanDisk is worth a lot, actually. Oh, it's only a $6 billion company. Okay. Well, Daniel sold his last company to SanDisk, and then was kind of mentored by the CEO of SanDisk. Shai obviously started Fiverr, and then when Fiverr went public, he's like, okay, what's the next thing here? So Shai was thinking about his next startup idea after Fiverr went public. And I believe it's funny enough, he was taking a Stanford class just to learn. He was just, okay, our new company just went public. It's insane. I mean, Fiverr ran up to $300 a share. It's 20 now. So that means it was worth well over 10 billion at one point. And he's like, okay, what's next? He was taking a class at Stanford, and he learned that insurance was worth 8% of US GDP. And he could not believe how big insurance was and that most companies were over 100 years old. He was like, wait, this is one of the biggest industries in the world, and we haven't had any innovators in it in 100 years? What's going on? And that's why Shai decided that insurance was what he wanted his next big kind of legacy company to be. his final startup, his largest startup, his legacy creating startup. And Daniel came to the same conclusion, and then I believe they were actually introduced to each other by a mutual investor who had previously invested in both of them. And he's like, hey, you guys are both great founders, and you both want to start an insurance company. You guys should probably talk to each other. And it turns out Daniel is a super great CEO, and Shai is a super great technical lead. And it's just a match made in heaven right there. Okay, so third point of background here. So we talked about how Lemonade's an AI company, how they have a proven founding team. Third thing I want to talk about is Lemonade's trust dynamics. So if we go over back to the feed here, let me just read this. Lemonade delivers AI-powered renters, pet, car, homeowners, and life insurance across the US and EU. We process claims instantly, keep costs low, and donate unused premiums to causes our customers choose. Okay, so this third point actually gets a lot of people to turn away from Lemonade when it's actually one of the most bullish things about them. So Lemonade's gross loss ratio was 76%. If their loss ratio falls below 40%, Lemonade donates excess premiums to charity. This completely changes the trust dynamic, because for a normal insurance company, you know, the insurance company hates me. When I file a claim, they hate me because any dollar they don't pay me, they keep. So literally paying me causes them to be less profitable, and they're going to do everything they can to drag their feet, not pay the claim, maybe pay it next quarter instead of this quarter so that the quarterly earnings looks a little better. You know, Lemonade is saying, let's change that trust dynamic. There's two parties here. What if we introduce a third party? What if we introduce a party that the customer cares about? And they know, hey, if loss ratios drop really, really low, we're not just profiting all of that. It's going to go to your charity. That drastically reduces the amount of fraudulent claims. It's not completely, right? Lemonade's AI still is getting better and better at fraud prevention, and that's really important. But the other thing it does is Lemonade talks a lot about how many customers will like file a renter's insurance claim because something got stolen, and then they find it later. They realize, oh, I just lost this, I found it. And the customers will actually reach out to Lemonade and say, hey, I found this product, can I give you this money back? This never happens in insurance. The only reason it happens with Lemonade is because customers trust Lemonade more, customers love Lemonade more, and customers know that some amount of the premium is gonna be paid or donated to a charity. And introducing that third party into the insurance dynamic is perhaps as big of an innovation for insurance as AI, which I know is a big thing, and viewership always drops. People always get really uninterested when I talk about this. But this is a really big deal, especially because in the future, right, when Lemonade is a fully autonomous, infinitely scalable organization, and that's, you know, Lemonade's management's words in the in the 2024 Investor Day, an infinitely scalable autonomous organization. Those aren't my words. Where Lemonade can add an infinite number of new customers without needing to add new employees. That's what they're talking about. And an AI super intelligence is literally running Lemonade. And for those of you guys who don't know, like Lemonade is kind of training like the super intelligence brain here. So if I pull this up, this is really old. This is the last time we actually saw this back in 2022, kind of the back end of Lemonade's ontology. These pinks are the actual products, so like car, renters, home, pet, whatever. These blue are all AI models. So these are all artificial intelligence LLMs. The green are features. So these are different API features, different tools that the AI can use, can interact with to do stuff for customers. And then the yellow are data sources. So these are sources of data that are updating in real time that the models train off of. So Lemonade's models are literally improving in real time based off of billions of data points and getting ever better at all of the different jobs that exist within insurance. So in a future where Lemonade is by far just dominating everyone because no one can even get close to their costs, because remember, Progressive is hiring 12,000 employees while Lemonade is automating all of the jobs that Progressive is hiring employees for. In that world, Lemonade could take a significant amount of the market share of insurance, and they could price out a lot of competitors eventually. And I think it's really good that an AI superintelligence has a safety net here that we've been talking about of this kind of charity side of things, so that once, like, if Lemonade's AI and superintelligence just outcompetes everyone and puts everyone else out of business, the AI can't then just raise premiums and then start collecting, start ripping everyone off in an insane way where payouts are only like 20% of premiums. I mean, that would then open up the potential for future competitors to come in eventually, but that would take a long time if Lemonade is already, dominating the entire market. So it kind of puts a safety net market there where the superintelligence, as smart as it gets, is only ever going to have a loss ratio around 30% lowest, which is still crazy. That's a 60% gross margin. So that's, I mean, most insurance companies have almost no gross margin and make all of the money off of interest income. So this would be insane still. And I think people will appreciate that the AI overlord is donating to charity someday when Lemonade's AI brain is, AI superintelligence is smarter at insurance than any single human could possibly dream of, because it has been training for decades on all of this data and literally learns off of every single customer interaction, whereas like a normal customer service agent only learns on their own individual interactions. An individual kind of claims adjuster or underwriter only learns off of the policies they're underwriting or the claims that they're deciding whether to pay out. Lemonade's AI is learning off of every customer interaction in every department all at once, everywhere all at once. It's so exciting. It's so cool. Okay, so first, AI company selling insurance. Second, proven founding team. Third, changing the trust dynamic. Fourth point of background I want to cover here is that Lemonade is pretty much what Palantir would build if Palantir started an insurance company. Ontology and all, which we were just kind of going over the ontology here. So I don't need to cover this in more detail, but like Palantir is going to be good for other insurers, right? Palantir is going to help other insurers become slightly more efficient. Progressive's 12,000 new employees that they're hiring this year. AI is going to help them, all be slightly more efficient. In fact, Progressive said AI helped them go through the job applications in order to hire their 12,000 new human employees. So AI is helping these traditional insurance companies. Palantir working with Progressive, it's going to help them probably underwrite 10 times faster. It's going to help a human underwrite 10 times faster than they were before. It might help customer service employees respond to more emails by helping auto write some of it, or providing a summary of a customer complaint or something. Lemonade removes the human from the loop entirely. So these on the edge improvements that Palantir will 100% unlock for traditional insurers, it's going to make traditional insurers far more profitable. Don't take me wrong. These on the edges, kind of on the margins automation that that Palantir allows companies like Progressive to do is actually going to stop them from feeling the pain that they would need to feel in order to think that they have to rebuild everything from scratch. So I'm very confident that traditional insurers will use insurance and will never build anything close to what Lemonade has or even attempt it. Before they're just way too far behind that it doesn't even matter. So Lemonade is what Palantir would build. And that's why we're seeing, sustained operational leverage driven by AI and automation, where over 3 years, Operating expenses, excluding growth spend, decreased by 10% over 3 years and over a doubling of premium. It's crazy. Okay. So then the next thing I want to get into here, number 5, is valuation. So let's look at Lemonade's valuation here for a second, because I think that it's quite cheap in many different ways that you look at it. I like Yahoo Finance a bit better. So if we go to statistics here, are up 10% in pre-market, not bad. Just so you guys know, we're currently waiting for the earnings call to start, and it will be starting here in 24 minutes. So in the meantime, we look at Lemonade's enterprise value, 2.5 billion, and they have $1 billion of cash, but policy liabilities sit on the balance sheet as liabilities. So the enterprise value, but obviously like all of those liabilities are going to have to get paid out, right? Like Lemonade's loss ratio is in the 60% range. So I think this is a little bit misleading in that their enterprise value is actually slightly even better than this. But even if we're looking at this, it's a price to sales of 4.75. Now, keep in mind, just off of this, if we compare it to AI peers, okay, so HIMS isn't even an AI stock, but let's put HIMS in here. I mean, okay, obviously Palantir, but this is not really that good of a representation because it's kind of crazy overvalued right now. Let's look at Tesla. Okay, so let's go to stats for all of these. Okay, so HIMS trading 8.6 times sales, or 8.56 times sales, 25 times book. You know, where Lemonade's less than 5 times book as well, and 4.7. And HIMS isn't really using AI. Lemonade is a fully AI company. I don't think it's really even fair to call HIMS an AI company on the same level of Lemonade. It's not fair at all. Okay, this is just ridiculous. Palantir 128 times sales, almost 70 times book. Okay, let's just take that one out because that's ridiculous. Tesla 11.7 times sales, 12 times book. So if you look at even just Lemonade compared to HIMS, you know, we're looking at a company that's half as expensive as a lot of these other big, well-known companies. And if you compare it to like private companies like Anthropic or OpenAI, like these companies are all trading in the hundreds of price to sales, similar to Palantir. So in that sort of a world, you know, it's like 10 times cheaper, 20 times cheaper than some of these base model companies. But here's the kicker. This is where it gets crazy. This price to sales is based off of revenue, which we were just looking for Lemonade. It looks like their revenue trailing 12 months is only 559 million. In reality, Lemonade has 1 billion of in-force premium, which is that should be what's counted as their revenue. But because they have, over the trailing 12 months, reinsured 55% of that, they cannot claim 55% of the current in-force premium as revenue, which makes their revenue look, you know, half as much as their IFP. But because Lemonade updated reinsurance, and by the way, if you guys didn't see this, Europe grew over 200% year over year. By the way, Europe expansion, which is Germany, France, UK, and the Netherlands, which was crazy. But reinsurance, because they just dropped reinsurance from 55% to 20%, that is going to be a 35% boost in revenue over the next 12 months, combined with a 30% boost in in-force premium, which means that over the next 12 months, we are going to see this multiple here. This is going to drop to 2. Over the next 12 months, this is going to drop to 2, maybe 2.5. So it's even cheaper than it looks. Like, not only does it just look cheaper than other companies, what are some like other like really big ones? Let's do like Upstart or Hood. Let's look at Hood. Hood's Hood's a pretty popular stock right now. Yeah, so 27 times sales, Lemonade 4.75, and it's going to be dropping to 2.5 this time next year. What's another big popular company? Upstart. Look at Upstart statistics. Yeah, 10 times sales. So more than twice as expensive on a price to sales basis. This is just one way to look at it. More than twice as expensive on a price to book basis. And Lemonade's current sales are underestimated by 50%, and that's about to change over the next 12 months. So it's going to be really exciting, and I think people are going to start understanding just how cheap Lemonade is. For a company that's freaking doing this, dropping expenses by 10% over 3 years. I just still can't get over this. This is just so crazy. So crazy. Okay, so let's keep going through the list here. So 28 minutes till the call starts, by the way. We talked about Lemonade's an AI company selling insurance. The reason that they're selling insurance is because it's fully automatable, worth 8% of GDP, ripe for innovation. We talked about how it's a proving founding team. We talked about Shai and Daniel's backgrounds starting Fiverr, Shai starting Fiverr, Daniel selling a company to SanDisk. We talked about how they're changing the trust dynamic in insurance by introducing a third party, which is a charity. We talked about how if Palantir was starting an insurance company, it would be Lemonade, and Lemonade is doing stuff that companies like Progressive can't even dream of and are still hiring people because they are not automating systems. We're looking at valuation. Okay, so they're selling for less than 3 times in-force premium. So price to sales might be 4.75, but price to IFP is less than 3, probably like 2.8 or something. The look-through PE, so if you assume that Lemonade is eventually going to be at 20% profit margins, which I think is very reasonable. If you think that Lemonade is eventually going to be at 20% profit margins, I mean, we can just run the numbers here. I'll show you how to calculator. Oh, this is a compound interest calculator. I love compound interest calculators, but that's not what I'm looking for. I only search for compound interest calculators, I guess. Okay. So in-force premium 1083. So that's 1 billion. So now if we multiply this by a profit margin of 20% to get our look-through PE, you can see it would be a look-through earnings of 216 million. So if we now take Lemonade's current market cap, which is up today, right? Because the stock's running a bit. Let's see here. Market cap is 2.7 billion. So we're going to do 271 divided by 216, which is earnings, right? So it's worth 2.7 billion. Look through earnings, assuming a 20% profit margin, is 216 million. So you divide, and you're looking at a look through PE of 12.5. That's crazy. That's crazy, guys. A look-through PE of 12.5 for a company that just put up revenue growth of 35%. So revenue is growing 35%. It's going to be accelerating over the next 12 months to nearly 100% revenue growth. And it's trading at a look-through PE of 12.5. Disgusting. Just absolutely disgusting opportunity that we have here. If you agree that Lemonade can get to a 20% profit margin someday, which if you don't think they can get to a 20% profit margin someday, are you looking at these numbers? Are you looking at the fact that they have been shrinking operating expenses while doubling over the last 3 years? Because if you don't think they can get to a 20% profit margin, you must think that this is an impossible thing to continue. When Shai has said they have built an autonomous platform for 10 million customers right now, they have only 2.4 million. So that if you just take that head on, that means they could 4x customers on the same platform without any new employees, which means potentially, they can keep this under 100 million of operating expenses, excluding growth spend, even with 4 or 5 billion of in-force premium. And if that happens, it's like 20% profit margins could be conservative. It could be very conservative. And if you do a look through PE of 20, then they already, they would have 216 million of profit off of their over 1 billion in IFP, and dividing their market cap by that, it's trading at a 12.5 look through PE. So much cheaper price to sales, even when they can't count half of their revenue right now, and they will be able to count 35% more of their revenue 12 months from now. Looks really cheap on a price to sales basis compared to everything else. An insanely ridiculous look through price to earnings ratio of 12.5, assuming a profit margin of 20% on backwards looking revenue. And then they're guiding for, a 30% CAGR for the next 10x. So Peter Lynch, by the way, if you don't know, everyone should read this book. This book is incredible. You can actually listen to it for free on YouTube, the full audio book. But Peter Lynch in this book, One Up on Wall Street, he was a prolific growth investor. He's one of the best performing hedge fund managers of all time. Definitely the best performing in the last 100 years. He managed for Fidelity and Magellan. He averaged almost 30% annualized returns. And his rule of thumb is that if you can buy a growth company for a price to earnings equal to growth rate, it's a fair deal if the growth rate is sustainable. If you're buying a growth company for twice as high of a PE as their growth rate, it's expensive. It doesn't mean you can't make money, but it's probably expensive in the short term. So, for example, what is HIMS? I think HIMS look through PE is probably like around 25 or something right now. And they're guiding for 20% revenue growth over the next 5 years. So it's about fair. HIMS is about a fair deal right now. If you do a look through PE of 20, look through PE of 25, and a growth rate around 25, Peter Lynch would say that's a fair deal. Lemonade has a look through PE of 12.5 and just put up revenue growth of 35% year over year. Second quarter revenue increased by 4.2 million or 35% as compared to the second quarter of 2024. So we're looking at a revenue growth 3 times higher than look through PE. Revenue growth 3 times higher than look through PE. If you think Lemonade can get to a 20% profit margin someday, the stock is it's so undervalued. I'm biased. I'm all in Lemonade. Just know that. But I'm all in Lemonade because of these numbers. I don't think these numbers are crazy because I'm all in Lemonade. Okay. So less than 3 times IFP, 12 look through PE. And management has guided for over a 30% CAGR average from 1 billion in IFP today to 10 billion in IFP in about 7 years is what they're guiding for. Okay. So we've covered a lot of the points of background here. Okay. Yeah. So I could talk about my discounted free cash flow model as well as another way to value the company. And by the way, earnings call starts in 20 minutes. So we are getting close, everyone. We are getting close. We are now to over 500 views on YouTube, 2.5 thousand viewers live on X. Thank you guys all so much for being here. I appreciate it. Drop a thumbs up, by the way. If you're watching on YouTube, please drop a thumbs up. I would love that. It will help bring more people to the live stream before the call starts. And then I don't think you can drop. I guess you could drop a like on X as well and retweet it here. So our discounted free cash flow model assuming a 15% discount rate. And I should probably do a whole video just like kind of covering all of our expectations here about, you know, earnings expectations, profit margin expectations, revenue expectations. But I'm not going to do that right now. So our price target for 10 years from now is about $777. You discount that back 15% a year for a 15% kind of discount rate. And Lemonade is worth $190 today compared to my own discount model. And right now we are trading at, I probably shouldn't use macro trends for real time stuff. Right now we're trading at $40. So $190. It essentially what my model is saying is that if you bought Lemonade today for $190, and we are right, what my analysts and I are modeling, if we are right about Lemonade's growth rate over the next 10 years and profit margin 10 years from now, then you will get a 15% annualized return from today at $190 to 2035 when the stock should be around $777. Okay, but it's not trading for $90 today. So if if it's not trading at $190 today. So if at $190 you're getting a 15% annualized return rate, I'll let you guys calculate the return rate that you're getting from $40. I believe it's close to 40% or something ridiculous. Maybe 35% is the annualized return rate I'm expecting from now till 2035. Okay, so that's valuation. We did price to sales, look through PE, discounted free cash flow. Oh, another way that you could calculate Lemonade's valuation is by looking at the cost to acquire customers. Oh man, I do too many posts, but I did a post about this a while ago that I thought was pretty decent. I tweet like so many times a day that it's probably not worth doing this. So we'll just run the numbers fresh. So in insurance, let's just do a quick Google search. How much does it cost on average to acquire an insurance customer? By the way, Google's Gemini is not bad here. Normally when I'm on my own, I do go to Grok, but this is, don't you guys think this is kind of bullish Google? The fact that I'm kind of just getting AI answers straight from Google now. Okay. So 900 overall average. Some sources suggest CAC in the insurance industry is 900 per customer, according to William Blair and Co. Other sources, average cost of acquiring new insurance customers ranges between 800 and 1300. Okay, so let's do 900 per customer is the cost to acquire customers. Lemonade now has 2,693,107 customers. One of those is me as of Q2 2025. So if we go now, calculator. Okay, so we do total customer count. Can I not copy from here? Okay, fine, I'll do it manually. 2693 107. Okay. Now we are going to say the value of each of these customers, or the cost to acquire each of these customers, is $900. Okay, so the cost to acquire all of Lemonade's customers, why does Google not have commas here? Like, short Google, please. I'm just kidding. Okay, so the cost to acquire all of Lemonade's customers is about $2.5 billion, assuming the average cost. $2.5 billion is essentially like the cash that you would need to get from 0 to where Lemonade is, not including building the AI infrastructure, the ontology, setting up the training algorithms, training your AI, actually automating all the tasks, all the engineering talent you need for building the Lemonade platform. All that aside, it would cost you $2.4 billion. Now, just as a reminder, Lemonade right now is currently worth $2.7 billion. So that means just buying the customers without the company, without the AI platform, the training platform, without the incredible team, Shai, Daniel, the incredible AI team, all the engineers, just buying the customers would cost you $2.4 billion. And you can buy the whole company right now for $2.7 billion. And then you think about the fact that Lemonade currently has free cash flow and $1 billion, over $1 billion in total cash. And it's like, holy crap. Wait, so you're telling me that I can buy this company with that has $1 billion in cash. So if you back that out, for $1.6 billion, and just acquiring Lemonade's 2.69 million customers would cost me $2.4 billion. So if you count the billion of cash that Lemonade has, it is literally cheaper to buy insurance customers through purchasing Lemonade than it is to acquire them yourself in your own company. So it's freaking insane. So we do have the stock cooling off a little bit right now. This is really good. I actually hope, I'm happy to see this because I'm probably going to, use a bit of margin and add a few more shares. I'm going to keep it safe, but I'm probably going to add a bit more shares. But we'll see how this earnings call goes. We're now 13 minutes away from the launch here. It looks like the music has started, so let me mute that. So we are counting down here, guys. T-minus time for start is happening. So Lemonade looks really cheap if you just look at a price of sales. It's really cheap if you look at a look-through price to earnings ratio. It's really cheap if you use Peter Lynch's kind of quick back of the napkin kind of valuation metric that he likes. It's really cheap based off of my discounted free cash flow model, which had a 15% discount rate. Says Lemonade should be worth $190 today. And then maybe the thing that makes it look even the cheapest is the fact that acquiring Lemonade's customers at the average price of $900 per customer, which is what AI told me, it costs to acquire a customer. And you add the billion of cash, it's ridiculous. The cheapest way to get insurance customers right now is just literally buying Lemonade. And if you run this sort of calculation on another big insurer like Progressive, by the way, it's nothing like this, right? Like Progressive, you're still paying a crap ton for the company, even after you back out the cost of acquiring all of their customers. Okay. So then, I guess the last thing I want to mention here before we start waiting for the earnings call in about 11 minutes is this idea that the longer the base, the bigger the breakout. So there's one thing I tweet out quite often is this chart I like a lot. How many people have retweet this, guys? Go retweet this. This right here. So this is Lemonade top line here. So this is showing 373. Now we're over 400% if you count Q2. Are around there. 400% top line growth since they IPO'd in Q4 of 2020. And the stock, while top line has grown 400%, the stock is down 65%. So the stock has been moving at a compound annual growth rate of negative 21%, while top line has been growing at a compound annual growth rate of 44%. So when you have the price moving down 20% a year, while the revenue, in-force premium is going up 44% a year. The longer this opposite direction moves, the longer that you go in an opposite direction, the bigger the base that you're forming is, and the more insane the eventual breakout is going to be. And by the way, my fair value price target of $190 is only about right here. It's about similar to this peak here. So, you know, we could fly much higher than that and still have a positive return over a decade. I do think Lemonade was probably it was overvalued back here, but now it is so ridiculously undervalued. And it just goes to show, like, markets are not efficient at all. I think markets are the opposite of efficient. I think the way that Warren Buffett describes the market as your kind of drunk neighbor who just comes, knocks on your door every day and says, today I'm willing to pay this much for your house. And sometimes, you know, they're manic depressive. So sometimes they're like super happy and they're willing to pay you like 5 times more than your house is actually worth. And sometimes they're super depressed and they're almost willing to pay you nothing for your house. And that's when you buy the house from them. You're like, okay, I'll buy your house from you if you think that's how much it's worth. And then if it's really insane to the upside, then maybe you can sell them the house when they're willing to pay you way more for it than it's actually worth. But it's not efficient. It's manic depressive. It far overbids things when it gets excited about an opportunity, and then it far underbids things when it gets pessimistic about an opportunity. And we are currently on the pessimism side of this base. And yeah, for all of these reasons, vote affirmative. I mean, look into Lemonade stock. I think it's a really great undervalued company with a super long base here. And nice. This is epic, guys. Okay, wait, I'm going to make a quick buy real quick before the earnings call starts. I'm okay if you know, the market wants to go down today on a double beat guidance raise. If they want to do that, I'm totally happy with that one. And I will buy more when the market is open, but I'm just going to put in a little order here at 5% up only. Let's see here. Let's do like a, I don't know, maybe like I don't want to use too much margins. I'll just put like maybe 500 share buy right now, like $20,000. And for anyone who's just joining, we are currently waiting for the Lemonade earnings call, which will be starting here in about 7 minutes. So go grab a coffee, go grab your breakfast. You got 7 minutes until the call starts. You know what? I'm going to do 1,000 shares. I'm going to do 1,000 shares. At a 5% up in pre-market only. Let's see, by outside real-time hours. Nice, order fulfilled. Bought 1,000 shares in pre-market. What is volume looking like so far? I'm guessing volume's probably picking up a little bit. No, volume is still really low so far in the pre-market. Yeah, we're at 135,000 shares traded. So we really have no idea how the street's going to react to this yet. I don't think this is really Wall Street. This could literally be all retail. This could all be people watching my stream right now. Although some of these sell-offs, like right at 7 a.m., right at 7. So this was all retail. And then right at 7 p.m. Eastern time, this might have been Wall Street. And then this is retail again. But Wall Street doesn't know what they're doing. Wall Street doesn't know what they're doing. All right, let's see what questions people have. Why are you saying revenue growth in the 30s? Didn't IFP grow by 29%? Yeah, so good question. So revenue is going to be growing much faster than in-force premium. Why? Because of reinsurance renewal. 55% of Lemonade's current premiums are reinsured. Reinsured premiums cannot be claimed as revenue according to generally accepted accounting principles GAAP. So according to GAAP, 55% of Lemonade's current premiums cannot be counted as revenue. That's why it looks like Lemonade only has like 550 million of revenue, even though they have over $1 billion of premiums. Well, Lemonade announced they are reducing reinsurance from 55% to only 20%. Why? Well, because their loss ratios are getting insane. We're about to see 60s trailing 12 month. I mean, this quarter, if you just look only at Q2, we're already in the 60s. So there's no reason to reinsure anymore. Lemonade's AI is really good at underwriting now. Okay. So what this means, by reducing premium cession related to quota share reinsurance, we keep more of the business on our books, thereby retaining more revenue and gross profit. So what this means is that a reduction in our quota share program increases our revenue retention and yields a period during which revenue growth rates are expected to outpace in-force premium growth. So just this quarter, which I don't think was really much affected by this at all, so we're going to see much more of this, we saw in-force premium grow by 29%, but we already saw revenue grow by 35%. And this is going to keep scaling up. Next year, we are probably going to see, even though IFP is only going to grow a little north of 30% in 2026, we are probably going to see revenue growth north of 50% in 2026. Simply by reducing reinsurance from 55% to 20%, unlocking an additional 35% of premiums as claimable revenue, while simultaneously increasing margins. So it's a really kind of bullish moment. Okay. We are now looking 3 minutes. 3 minutes until earnings starts. Models are meant to be illustrative, not predictive. Yeah, exactly. So like my expected 77x in 20 years, this could easily be 150x, could easily only be 50x. What matters is directionally, modeling allows me to see that Lemonade is more than twice as good of an opportunity as anything else I can find and model in the market. Okay, Since 91 says, there is no doubt in my mind that this stock will reach 1,000. I 100% agree with you. It's a matter of when, not if. Thanks for the stream. You're welcome, Chex Mix. Thank you guys for dropping your thumbs ups and retweeting the stream on X. I really appreciate that. Congrats on a great quarter, everybody. Yes, Scott. It really is a great quarter. I cannot wait to listen to management here in about 2 minutes. Cindy Zhang says, did you look into the fact that Root grows much faster than Lemonade? Root is going to be growing much, much slower than Lemonade looking forward. So this is actually perfect. This is really good. Maybe I can do this in 2 minutes. I'm going to turn this music on really light just in case I can hear it if they start talking. But if we go to Root macro trends, Root recently reduced reinsurance. So what we've seen from Root is it looks like Root's revenue growth has been freaking insane, right? Look at this, like revenue growth for Root, 176% up. Wow. 264% up. Wow. 285% up. Wow. But now guess what? We're seeing a fast deceleration, 166, 60, 67, 36, and we are going to see Root's growth rate drop even further now. Why did Root see this crazy increase? Well, because Root did previously what Lemonade is doing now. Root reduces reinsurance. So remember, stuff that you reinsure, you cannot claim as revenue. So back in 2024, they reduced reinsurance, which I believe was the second time. But yeah, Root pretty much has almost no reinsurance anymore. So Lemonade, still looking backwards, has 55% reinsurance. 55% of Lemonade's revenue, Lemonade's premiums, they cannot count as revenue. Root has almost no reinsurance anymore. They already cut it all out. So we're about to see a crazy, revenue growth acceleration for Lemonade as they are reducing reinsurance, like we have already seen for Root, because they previously just finished reducing reinsurance. So Lemonade's growth rate is going to just continue accelerating. Ooh, we're seeing even lower. I think I might go buy even some more shares here. We'll see if I can. Okay, the call should be starting here now, by the way. I'm going to shut up as soon as they start talking. And we will let ourselves fully immerse into this. What do you guys want to see? Probably showing this is pointless, right? Oh, unless they show slides. If they show slides, we'll show this. If they don't show slides, then perhaps we can like watch the stock while it moves, or maybe as they're going through it, we can follow along on the shareholder letter. But I'm gonna go make another buy here. Let me see if there was any other questions that anyone had. Root NPS scores are far lower than Lemonade. Yeah. Every single insurance company has worse net promoter scores than Lemonade. Okay, here we go.
Good morning or good afternoon all. Welcome to today's Lemonade Q2 2025 earnings call. My name is Adam and I'll be your operator for today. If you'd like to ask a question in the Q&A portion of today's call, please press star followed by 1 on your telephone keypad. I'll now hand over to the Lemonade team to begin.
Good morning and welcome to Lemonade's second quarter 2025 earnings call. Joining us on our call today, we have Daniel Schreiber, CEO and co-founder, Shai Wininger, President and co-founder, Tim Bixby, Chief Financial Officer, and Nick Stead, SVP Finance. A letter to shareholders covering the company's second quarter 2025 financial results is available on our investor relations website at lemonade.com/investor. I would like to remind you that management's remarks made on this call may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Actual results may differ materially from those indicated by these forward-looking statements as a result of various important factors, including those discussed in the Risk Factors section of our Form 10-K filed with the SEC on February 26, 2025, and our other filings with the SEC. Any forward-looking statements made on this call represent our views only as of today, and we undertake no obligation to update them. We will be referring to certain non-GAAP financial measures on today's call, including adjusted EBITDA, adjusted free cash flow, and adjusted gross profit, which we believe may be important to investors to assess our operating performance. Reconciliation of our non-GAAP financial measures to the most directly comparable GAAP financial measures are included in our letter to shareholders. Our letter to shareholders also includes information about our key performance indicators, including customers, in-force premium, premium per customer, annual dollar retention, gross earned premium, gross loss ratio ex-cat, trailing 12-month loss ratio, and net loss ratio, and a definition of each metric, why each is useful to investors, and how we use each to monitor and manage our business. With that, I'll turn the call over to Daniel for some opening remarks.
Good morning, and thank you for joining us to discuss Lemonade's results for the second quarter of 2025. And it's a pleasure to report that really across all of our key metrics, our financial performance in the quarter was excellent. On the top line, we delivered our 7th consecutive quarter of IFP growth acceleration with 29% year-on-year growth, and concurrently, our gross loss ratio for the second quarter was 67%, 12 points improved relative to Q2 of last year, and this brings our trailing 12-month gross loss ratio to 70%, our best results ever, and squarely within the healthy range of our business model. It is worth noting that just 1 year ago, our IFP was growing at 22%, and our trailing 12-month gross loss ratio was 79%. And while neither metric was too shabby, 12 months on, both have improved dramatically. This, I believe, is a clear testament to our ability to leverage AI to pinpoint target risks with accuracy and deliver profitable growth concurrently. As a result of these dynamics, our gross profit grew by over 100% in the second quarter, and our gross margin at 39% is among the highest we've ever recorded. And what's more, the growth of our top line eclipsed any growth in our underlying expense structure. And as a result, we saw strong adjusted free cash flow generation of $25 million, more than a tenfold increase relative to the second quarter of 2024. In recent quarters, we have been highlighting Lemonade Car's progress, and in Q2, we continue to see that momentum build. Through the first half of the year, CAR's growth has significantly exceeded our original financial plan. It has now crossed $150 million of in-force premium and continuing to grow. Product enhancements have fueled conversion rate gains, and geographic expansion has been another tailwind. Concurrent with that, it's important to note that our CAR gross loss ratio has improved dramatically, with Q2 result of 82% marking a 13-point improvement relative to last year. Switching gears, we recently announced the renewal of our reinsurance program at similar terms to the expiring program, with one important exception, which is that we reduced the scope of our quota share program from 55 to 20%. It is worth underscoring this decision was solely of our making. The confidence to make such a move directly stems from a multi-year track record of improving loss ratios as key products and geographies have become more mature and predictable. In his remarks a bit later on this call, Tim will walk you through a couple of important related nuances on the capital efficiency and accounting. But before that, let me hand off to Shai for an update on our European business. Shai?
Thanks, Daniel. Before I get to Europe, I wanted to highlight a couple of updates to our new investor relations website, which can be valuable for those new to the Lemonade story. This morning, we've added an investor presentation as well as a handy spreadsheet with key financial metrics. We hope you'll find these helpful. We first launched Lemonade in Europe, in Germany in 2019, and now service over 250,000 customers across 4 key European markets, the UK, Netherlands, France, and Germany, and 2 products, renters and homeowners. Europe is of growing importance for a few reasons. It yields a diversification benefit to our growth, with notably lower cat exposure and a flexible regulatory environment. In the past few quarters, we've really seen our European business come into its own and is now a meaningful driver of growth for the organization. We concluded Q2 with $43 million Europe IFP, which represents over 200% growth, our 8th consecutive quarter of triple-digit growth, and our 4th consecutive quarter of growth rate acceleration. I'm pleased to report that the story in Europe is very similar to what Daniel highlighted in our car business. Growth acceleration has been paired with improvement in underwriting performance. We saw an 83% gross loss ratio in the second quarter, 15% improved relative to last year, and roughly 20 points better than where our US business was at a similar scale. This performance is powered by structural cost advantages driven by our AI platform. One great example of this is a technology we call Loco, our LLM-first, no-code insurance application builder. With Loco, we can rapidly build new products, launch new regions, iterate on pricing and underwriting, and experiment with various dynamic experiences, all in hours instead of weeks, and without touching any code. Loco is a powerful platform that enables us to manage our multi-continent insurance company with unmatched efficiency. Where our competitors have large local teams on the ground in the regions they operate, and with each region having its own specific legacy infrastructure, our proprietary technology enables us to expand our geographical footprint with unmatched velocity and limited incremental overhead. We are clearly in the early innings of our European journey at Lemonade, but believe Europe is positioned to remain a key engine of rapid, profitable growth for years to come. And with that, I'll hand it off to Tim, who will cover our financial performance and outlook.
Great, thanks, Shai. I'll review highlights of our Q2 results and provide our expectations for Q3 and the full year 2025, and then we'll take some questions. In short, our Q2 financial results were exemplary across the board. We remain very much on track with our ambitious goals for positive EBITDA by the end of next year, loss ratio tracking to target, consistently accelerating top-line growth with little change in fixed overhead expenses, and favorable cash flow dynamics. In-force premium grew 29% to just above $1 billion, while customer count increased by 24% to 2.7 million. Premium per customer increased 4% versus the prior year to $402, driven primarily by rate increases. Annual dollar retention, or ADR, was 84%, flat as compared to the prior quarter, and continuing to show modest downward pressure as a result of our continuing effort to improve the profitability of our home book through targeted non-renewals. We expect ADR to normalize and resume improvement over the coming quarters. Gross earned premium in Q2 increased 26% as compared to the prior year, $252 million, in line with IFP growth. Revenue in Q2 increased 35% from the prior year to $164 million. The growth in revenue was driven by the increase in gross earned premium, a slightly higher effective ceding commission rate under our quota share reinsurance, and a 16% increase in investment income. Our gross loss ratio was 67% for Q2 as compared to 79% in Q2 2024 and 94% in Q2 2023. Excluding the total impact of CATs in Q2, roughly 7 percentage points, our gross loss ratio ex-CAT was 60%. Total gross prior period development had a roughly 3% favorable impact, 5% from non-CAT, offset by 2% unfavorable from CAT. We saw this favorable prior period development across all products, with the exception of pet, with the largest impact in our homeowners multi-peril business. On a net basis, prior period development was in line with gross, including non-CAT and CAT breakdown. Prior year development, which is reported on a net basis, was about $2.2 million favorable in the quarter and about $12.6 million favorable year to date. Trailing 12 months or TTM loss ratio was about 70% or 9 points better year on year. All of these insurance metrics and more are included in our insurance supplement that you'll find at the end of our shareholder letter. Gross profit increased 109% as compared to the prior year, while adjusted gross profit increased 96%, both driven primarily by premium growth and significant loss ratio improvement. Operating expenses, excluding loss and loss adjustment expense, increased 21% to $129 million in Q2 as compared to the prior year, driven primarily by an increase in gross spend and the impact of the $12 million one-time benefit from a tax refund. Other insurance expense grew 14% in Q2 versus the prior year at roughly half the growth rate of earned premium. Total sales and marketing expense increased by $23 million or 62%, primarily due to increase in growth spend of approximately $24 million. Total growth spend in the quarter was $50 million, roughly double the $26 million in the prior year quarter. We continue to utilize our synthetic agents growth funding program and have continued to finance 80% of our growth spend. As a reminder, you'll see 100% of our growth spend flow through the P&L, while the impact of the growth mechanism is visible on the cash flow statement and the balance sheet. And our net financing to date is about $124 million as of June 30. Technology development expense was up just 6% year on year to $22 million, while G&A expense decreased 13% as compared to the prior year to $22 million, primarily due to a one-time tax refund of about $12 million. Personnel expense and headcount control continue to be a high priority. Total headcount is up slightly, about 5% as compared to the prior year at 1,274, while the top line FP grew fully 29%. Net loss was $44 million in Q2, or a loss of about 60 cents per share, as compared to a net loss of $57 million or 81 cents per share in the prior year. Our adjusted EBITDA loss was $41 million in Q2 versus $43 million in the prior year. Our total cash equivalents, and investments ended the quarter at approximately $1.03 billion, up $11 million versus year-end 2024. And with these metrics in mind, I'll outline our specific financial for spend at a level similar to the Q1 rate, and thus totaling roughly $173 million for the full year. This expected quarterly spend pattern is similar to prior years. For the third quarter of 2025, we expect in-force premium at September 30 of between $1.144 and $1.147 billion. Gross earned premium of $267 to $269 million. Revenue between $183 and $186 million. and an adjusted EBITDA loss of between $37 and $34 million. Stock-based compensation expense, we expect to be approximately $17 million, and a weighted average share count of approximately 74 million shares. And for the full year, we expect in-force premium at December 31 of between $1.213 and $1.218 billion, gross earned premium between $1.036 and $1.039 billion, revenue between $710 and $715 million, and an adjusted EBITDA loss between $140 and $135 million. Stock-based compensation for the full year, we expect to be approximately $61 million, and a weighted average share count for the full year of approximately 74 million shares. And finally, I wanted to make a couple of comments on the reinsurance transition as a follow-up to Daniel's earlier remarks. First, the transition from 55% to 20% quota share does not happen overnight. Each program is risk attaching, which means it covers policies written between July 2025 and June 2026, such that we expect the transition to unfold over several quarters on our P&L in a roughly linear fashion. By Q3 2026, we expect to be ceding roughly 20% of premium, and in the second half of 2025, we expect to cede roughly 45% due to those transition dynamics. Second, a reduction in our quota share program does increase our revenue retention, but has no impact on IFP. As a result, that covers some of these dynamics in a bit more detail. And with that, I would like to pass over to Nick to answer some questions for our retail investors. Nick?
Thanks, Tim. We'll now turn to our shareholders' questions submitted through the Say platform. Paper Bag asked, what is your plan with synthetic agents going forward? Will you continue using synthetic agent funding in 2026 and beyond, or stop at the end of 2025? Great question. Thanks, Paper Bag. The synthetic agent program has worked precisely as intended when we launched it nearly 2 years ago and has enabled us to drive growth acceleration in a capital-light manner. In 2023, we deployed $55 million on growth. In 2025, we expect to more than triple our total growth spend to $170 million, now with an 80% advance from our synthetic agent. And while we do pay our synthetic agent a 16% IRR, the impact on our unit economics is transformational. The IRR on our growth spend is around 50% without the synthetic agent, and that doubles to roughly 100% with the partnership in place. There is a model live on our investor relations site posted alongside the materials from our 2024 Investor Day that covers these mechanics in more detail. The net impact of inflows and outflows to and from the synthetic agent leaves us with $124 million outstanding on the balance sheet at the end of the second quarter. We have already announced the 2026 renewal of our synthetic agent agreement with another $200 million of capital available to fund growth investment in 2026. At each renewal, we evaluate all strategic options available to us and will continue to do so. But in the near and medium term, we expect to continue to expand this partnership. Emmanuel O. asked, what is the largest impediment right now stopping Lemonade from releasing car to more states? We are currently live with our car product in 10 states and address roughly 50% of the U.S. car insurance market, a vast market opportunity relative to our current scale. That has been increasing with 2 state launches, Colorado and Indiana, in the past few months. We have planned to continue to increase our nationwide coverage and expect to launch multiple additional states through the end of 2026, such that our 50% coverage metric is notably increased. As we look to the state launch roadmap, several factors guide us. We evaluate the market opportunity, existing Lemonade customer penetration, and the regulatory landscape. Also, new state launches typically involve higher loss ratios, as getting a new state online requires rate adjustments post-launch and naturally brings a new business penalty impact. So we manage that strategically as well. I should note that at most other insurance companies, it takes considerable internal resources to launch a new state.
But with Loco, as Shai covered earlier in his remarks, we have substantially reduced the amount of work required by our insurance and product teams to do so, allowing our teams to shift to more impactful initiatives while maintaining our targeted pace of state launches. Emmanuel also asked, does the team believe that even with all of the developments in AI, that they are ahead of other AI-first companies in terms of the effectiveness and efficiency of the models? Well, the short answer is yes, we do think so. And you're right, Emmanuel, to focus on AI-first companies, as we believe the gap between us and incumbent insurers who are built on legacy systems is very likely to expand as AI development accelerates. We have been AI native since day one. Relative to new upstarts, that 10 years in market gives us a real data edge. Thousands of A/B tests, 10 million driving trips, millions of customer interactions and claims. When it comes to data, there's really no shortcut to that type of depth and scale. By the time generative AI really accelerated in 2023 and onwards, we already had AI embedded across the tech stack with terabytes of proprietary data flowing through the system. We stand apart from incumbents with a single AI system that connects every aspect of the business, and from upstarts with the depth and breadth of proprietary data that feeds it. So we believe we're really the only full-stack, multi-line insurance company with the tech stack and data to fully capture AI's potential. And this is playing out in our business outcomes. Our proprietary telematics pricing model now outperforms the off-the-shelf product that many competitors rely on. And over the last 2 years, our overall gross loss ratio improved by 27 points, while IFP grew by nearly 60% during the same period. Clear evidence that our AI flywheel advantage is compounding. For additional reading on this, I suggest you check out Daniel's recent Lemonade Turns 10 blog post and the investor presentation just posted to our investor relations site this morning to learn more about how AI drives our business performance. And with that, I'll pass it over to the moderator, and Daniel and Tim will take some questions from the street.
As a reminder, if you'd like to ask a question on today's call, please press star followed by 1 on your telephone keypad now to enter the queue. When preparing to ask a question, please ensure you are unmuted locally. And our first question comes from Jason Helfstein from Oppenheimer. Jason, please go ahead. Your line is open.
Thanks. Just a few questions around the reinsurance change, because I know a lot of clients have some questions there. So obviously you're holding more risk, but there is no free launch. Maybe just talk a little more about the structures you have in place, the way you can manage risk, and if there's ways to how you manage just the different ways that you can now manage the risk. And then there's like a follow-up to that. Does this reflect some kind of step function in you think the company's ability to manage risk? So like why now, I guess, is the question, right? So first is structurally how you plan on managing it going forward as this evolves. 2 is why now? And then I guess like the third is you did say revenue will outpace IFP, especially through this transition, but how should we think about gross profit relative to IFP growth? Thank you.
Hey, Jason, good morning. It is a significant change. It's been, I guess, the only constant here that we've been every couple of years stepping down the amount of quota share reinsurance since IPO from 75% down to 55 now to 20. So in that sense, it's a continuation, but nevertheless, a drop from 55 to 20 is significant and I think worth spending another few minutes on. The first thing that I'd highlight though, and then I will hand over to Tim to add a bit more color on some of these points, but quota share for us was not predominantly about risk management at all. We can use reinsurance to serve different goals. We have actually other policies in place that do manage risk concentration. So when a cat hits, for example, like the one that hit in Q1 in the California fires, and you saw that our gross loss ratio was much worse than our net loss ratio, that wasn't the quota share that was helping. Quota share in theory will produce very similar gross and net loss ratios because you cede X% of premiums and you see the same X% of claims, at first approximation, the gross and the net should be similar. If anything, because some cat events are excluded from the quota share agreement, you might see slightly worse net than gross loss ratios in quota share. In fact, we saw significantly better net loss ratios, and that was because of other policies that we have in place about risk concentration, covering losses beyond a certain dollar amount or too many losses in a particular quadrant or something like that. So we have various policies. Those continue. So the policies that we have in place that are helping us protect against risk concentration are not being materially changed. Quota share was in place, as I say, not predominantly as a tool of risk management, but much more so as a tool for capital management. The regulators require that we set aside certain percentage of our premiums. There's kind of a rule of thumb of 3-to-1, but when the insurance entities are fast growing and loss making, it can be more cumbersome still. And once you cede those premiums to quota share partners, it is really their capital rather than yours, and their cost of capital are lower. So we saw quota share predominantly as a tool for managing that aspect of our business, remaining capital light through quota share. As the last few quarters came in and we have consistently lowered and stabilized our trailing 12-month loss ratio, 67% this past quarter, trailing 12-month, which I think is the more dependable metric, if you like, less volatile, less given to the vicissitudes of a particular event. 70% trailing 12-month loss ratio is simply fantastic, perfectly aligned with our long-term goals. And what that has meant is that our insurance entities have moved from being loss-making to profit-making. Rather than consuming capital, they are generating capital. And that is something that changed over the course of the last few quarters. As we indeed became cash flow positive, we reported a $25 million adjusted cash flow this past quarter, a tenfold increase year on year. It is that more than anything else that's allowing us to take on board less or to utilize less quota share reinsurance. And of course, our quota share partners have been stellar. They've been amazing. They've been with us from the get-go. They're the biggest and most trusted names in the industry. But as you say, no free lunches. When you engage in quota share reinsurance, you are really margin stacking. You are giving up part of your business. You're getting the gains that I outlined before, predominantly capital efficiency, but you are sacrificing some of your EBITDA. And you really want to use, or we really want to use, as little of that as we need given our capital requirements. So that more than anything else is what's changed. We've moved from being businesses that are draining cash to those that are generating cash. Low loss ratios have changed the capital requirements significantly in those entities, and that is what is allowing us to be less dependent on quota share, and we made those adjustments. Tim, anything you want to add?
Yeah, just a couple of points on the second part of your question, Jason. One of note is that before you even get to our reinsurance structure, we do take advantage of one of our assets, which is our ability to grow at a very healthy clip, but be very selective about the risks that we take and the business that we write. And so in some ways, we enforce our own level of reinsurance by writing in certain areas of risk and not writing in others. Our risk in Florida, for example, is quite limited relative to a typical incumbent. Our experience in the California fire cat of Q1 was, before we even got to reinsurance, relatively limited because we're choosy about the level of risk we take in terms of high value homes. And so that's a layer that sort of underpins our reinsurance. Then we layer on reinsurance, of course. The bulk of the reinsurance structure at renewal remained unchanged. The quota share change in terms of its cede ratio was notable. Everything else is more or less in place and continuing. So we have protection against concentrated losses. We have protection against single large losses in our PPR and our FAC coverage, and those continue and were renewed at similar structural impact as in the past. With regard to the impact on gross profit and revenue, a couple things. We included a pretty straightforward example of what $1,000 of premium would look like under the old structure and now under the new structure, and how it flows through each of the key P&L line items. I would urge you to kind of look at that. It's in the back of the shareholder letter today, and I think that will be helpful to sort of navigate how the model is expected to evolve, particularly over the coming 4 quarters, as the change in the ceding ratio comes more into play. At a very high level, the impact on revenue is greater than the impact on gross profit. Gross profit for many quarters has grown at a very healthy clip, well ahead of the top line growth of IFP and premium, and that's because you're combining 2 elements there. You're combining the benefit of growth as well as the benefit of significant loss ratio improvement. And so those dynamics will continue, but our loss ratio, now that it's nicely in our target range, those shifts will be somewhat less than they have been over the past few years, and that's good news. Revenue, on the other hand, will be a little more, will grow at a faster pace, again, as the reinsurance change rolls in. And again, you should see those dynamics in the example that we shared.
Thank you.
The next question comes from Tommy McJoynt from KBW. Tommy, please go ahead. Your line is open.
Hey, good morning, guys. Thanks for taking our questions. Maybe to simplify the previous question and response, Tim, I think a couple years ago, you guys put out an illustrative slide showing the premium leverage that you could write at. Do you have an update on what sort of premium leverage on a gross basis you can write at, and then how that changes under this new reinsurance structure?
Sure. I think you're referring to some comments we've made from time to time regarding the capital surplus requirements relative to the premium we can write. Is that the crux of the question, I think?
That's right.
So you're correct to sort of trace the history a bit. When we shifted to a more material quota share reinsurance structure several years ago, one of the primary benefits, as Daniel noted, was the capital surplus benefit. Since then, a few things have happened. Our volatility has decreased. Our trailing 12 months loss ratio has come very much in line with our long-term targets. Our book is much more diverse, and we've put in place a couple of structural aids to captive reinsurers that are wholly owned or partially owned that we can now leverage. And the net of all that is our capital planning is substantially unchanged. How much of that capital surplus benefit we get from quota share versus our own captive entities has shifted somewhat. And so some of the surplus benefit that we give up as a result of the quota share shift, we get to retain more profit. We're able to replace that essentially in whole through our captive our captive structures. So net, we've talked about a 6-to-1 target ratio in the past. Historically, we've been above and below that ratio, depending on how the loss ratio and the premium growth and some other factors that impact that ratio have changed. But over the coming several year outlook, that ratio target for us is unchanged.
Okay, got it. Thanks for clarifying that. And then I think you made the comment that the insurance entities are, have gone from a phase of sort of losing, negative net income, driving losses, and sort of capital decreasing to a period of capital generation themselves because of the improvement in the loss ratio. When I look and I sort of reconcile that comment to the consolidated bottom line metrics, whether it be adjusted net income or adjusted EBITDA, that may imply some pretty sizable losses still at the holding company level. So can you just talk about sort of what capital has trended at the holding company level, apart from the insurance entities, just as we think about the need for potential more capital at the insurance entities to come from the holding company?
Yeah, there is some complexity when you look at each of the parts in isolation. You're correct that the particularly LIC, the Lemonade entity, is profitable and generating surplus. At a consolidated level, is how we kind of manage the overall capital availability. And we've talked historically of a parent capital cushion, which is basically a consolidated level, how much capital remains once we fund the growth plan, once we set aside the required level of capital that we are required today and that we are forecasting to be required based on our growth plans, and then what remains basically after satisfying all of those obligations. And that cushion has been more or less steady for quite some time. We've noted a level of around $200 million. That varies up and down, and that continues to be the level of cushion that we're comfortable with. And so at times, the parent company must fund the reinsurance companies. Currently, it's the opposite, where there's excess capital or excess surplus being generated at the insurance companies. But the big picture is we've got more than sufficient capital to satisfy all of those needs, with cushion left over for opportunities that arise, for weather events that are unpredictable, and all the risks that we understand can come our way.
Thanks.
The next question comes from Jack Matten from BMO. Jack, please go ahead. Your line is open.
Hey, good morning. Just a question on the car loss ratios, and wondering if you could just discuss some of the drivers of the improvement. Is there any like mix change we should be thinking about with renewal versus new business? Any thoughts you have on loss trends that you're seeing in terms of either frequency or severity in the car insurance line?
Yeah, so there is actually a fairly notable difference that we've been pleased to see unfolding, where it is typical in the insurance realm for renewal business to be at a more favorable unit economics than the initial policy. And in car, especially for us at Lemonade, we're seeing a much more notable difference, something on the order of 20 percentage points of loss ratio improvement from the first policy to the renewal policy. It is early, and so that continues to develop. But that's a really encouraging sign that we're both choosing risks effectively, and as you see the overall loss ratio coming down, but also that renewal is a great early indicator that we're doing this well. From a severity and frequency standpoint, generally across the business, we're seeing, and particularly in Q2, we saw a consistent theme of reduced frequency, but somewhat increased severity. And severity tends to come in the form of inflation of different sorts, whether it's expected inflation or existing inflation. But the net, as you see in the overall loss ratio trend, is that the favorable trends have been winning out and getting that trailing 12 months number down to 70%, which is the headline number, I would say.
Maybe I just add that it's not a mix, a change that is driving this. We're seeing both our new and our renewal business improving significantly. So it's really across the board.
Got it. Thank you. And just one your outlook. It looks like the IFP guidance for the full year doesn't imply much of an acceleration versus the 29% growth this quarter. I guess any reason you wouldn't expect further acceleration this year, given I think we're starting to lap some of the home non-renewals in the back half of the year. I mean, it looks like you're maintaining the outlook for kind of your growth spend this year as well. So just any color on the moving pieces there?
Yeah, I think there's certainly the potential for that. You've seen a couple of quarters, particularly the second quarter, where we were able to accelerate things. Things came together nicely. A couple of headwinds that we assume will come our way to varying degrees in the second half. There is some seasonality in terms of growth and higher growth in Q3 versus Q4. There's some churn dynamics that I think moved our way nicely in Q2 that we don't necessarily expect to replicate, although we could see upside there. And we continue to move forward with a project we've called sort of clean the book in our home book, which provides a headwind, but a good headwind. It aids our move towards profitability. We take advantage of an ability to non-renew certain business that no longer fits our underwriting guidelines. And one place you'll see that in our metrics is in our annual dollar retention metrics, which have been flat for a couple of quarters now. We estimate that there's roughly a 4% drag on that metric because of our home efforts to move more aggressively to profitability. So we're kind of balancing top line and the path to profitability. Notwithstanding any of that, we've seen 7 consecutive quarters of top line growth. We'll endeavor to continue that record. It gets a little tougher as we get towards our target cruising growth range of 30% plus, but we'll certainly aim to do that in the second half.
Thank you.
The next question comes from Andrew Andersen at Jefferies. Andrew, please go ahead. Your line is open.
Hey, good morning. Just wanted to go back to the car loss ratios, and I think you were saying you see a 20 percentage point improvement from the first policy to the renewal. I think in the past you've also mentioned that you were not expecting any type of new business penalty, and I think that was specific to cross sells. So maybe you can just kind of level set for us what maybe how much of the car book and how much of your car growth you're thinking of will be from the cross sells with no new business penalty versus some that is seeing a little bit higher first policy loss ratio.
That breakdown is not something we've sort of disclosed publicly. So I think I would probably point you to our some of the stats we shared about Q2 and going forward, that we expect to grow the whole car business at a faster pace than the total. And we expect to continue to increase our growth spend for car. Generally, about half of growth overall has come from cross sales. That's not 100% specific to car, but a significant amount of that is cross sell to car. And so that rough ratio I would expect to continue as well.
Okay. And then on the ad spend in the quarter was just a little bit higher than the guide, and you're keeping the full year guidance. Could you maybe just talk about some of the increased opportunities you saw this quarter that led to the higher ad spend, and maybe just touch on how you're seeing the competitive market for auto in the second half of the year?
Yeah, some of the growth spend is timing shifts, and this is not uncommon, where we'll see greater opportunity or we'll adjust the timing from one quarter to another, where the total year target and goal is right on track, but we see a greater opportunity, and so we'll move from one quarter to another. We're spending more on brand spend, and some of that tends to be a little bit more front loaded because you want to kind of get the visibility out there as more of a halo for going to the second half of the year, and that is some of the dynamic. So I think versus the beginning of the year, we've upped the total spend, but quite modestly, and the rest has been timing shift. I think we had in Q2 certainly we saw some nice upside from certain channels where if you look at the efficiency of the car spend, we were able to significantly increase it on a sequential basis, on a year-on-year basis. Yet the efficiency of the car spend, the number of dollars that each dollar of spend brought in, was stable and that's a nice, when you're doubling or tripling or more the spend and the efficiency remains stable, that's a great sign. And so we'll continue to kind of push that edge in Q3, which is typically a strong quarter of growth. The loss ratio trend is important, and so we kind of watch how that tracks. But we feels like we have a great foundation for continuance of these car trends in the second half.
And just on the competitive market, because it feels like a lot of the industry is reaching a pretty good profitability level and is starting to pivot to growth. It seems like your conversion rates are still strong, but maybe how are you just thinking about the competitive market?
Yeah, we can grow a great deal and still be a tiny drop in the car ocean. So we don't ignore the competitive dynamics. We tend to want to, where we can, give the benefit of our unit economics improvements or loss ratio improvements back to the customer so that our pricing is attractive. There's obviously a limit to that. But the competitive dynamics of the market tend to be secondary to what we see in terms of what our LTV models tell us about what are good risks and where the marketing efficiency is strong. So we feel like all systems are going into the second half.
Thank you.
As a reminder, if you'd like to ask a question, that's star followed by 1 on your telephone keypad. And the next question comes from Katie Sakis from Autonomous. Katie, please go ahead.
Hi, good morning. I wanted to circle back to the updates and guidance, specifically the full year 2025 EBITDA guide. I guess I was a little surprised to see that remained unchanged relative to last quarter, especially considering the progress that you guys have been making on both the reported gross loss ratio as well as the trailing 12-month gross loss ratio. So kind of a question there for you guys on whether you're expecting any increasing volatility in the back half of the year that might be informing your stable outlook on full year EBITDA. And then sort of adjacent to that, in reading the shareholder letter, it's the language on expectations for 2026 seem a little bit different for positive adjusted EBITDA before the end of full year 26. And I think on the last call, you guys had perhaps phrased it as positive EBITDA by 4Q26. Is there anything to read into the shift in language there?
Yeah, so on the EBITDA break-even, no change. Before the end of 2026, we expect EBITDA to be positive. So that's not a change. We have not indicated we expect the full quarter to be positive, although that's certainly possible, but we've indicated no change and expect that before the end of 26. One dynamic to probably highlight is when you look at the expected EBITDA of this year and then flow that into next year and then roll heading towards break even, you will see a dynamic where it's not exactly linear. And part of that is driven by our increasing growth spend, which increases adds cost to the cost structure. And when you grow at a faster pace, that premium that you bring in doesn't necessarily, or what doesn't, drop to the bottom line in real time. It drops over the early lifetime of that customer. And so as you accelerate growth, you see a dynamic where the bottom line doesn't change a whole lot, but the top line increases. And that's one of the things I think that helps us indicate that we're de-risking that bottom line trajectory. Every bit of incremental growth kind of adds to that lifetime value and that cash flow that we expect to spool out over the coming quarters. So the bottom line guidance for this year, you're correct, is unchanged, but it's really that dynamic of flow through from the top line to the bottom line, which has been the case for quite some time.
Got it. And then perhaps as a follow-up, in kind of thinking about the shifts that you guys have made to the quota share program and expectations for longer term profitability, is there a point at which your target for a low 70s gross loss ratio might, materially come down into something below 70%?
Never say
Daniel,
never, but
did you want to take that one?
Yeah, sorry. My mic was on mute. I apologize. Katie, what I was saying is never say never, but that's not our inbound kind of bias, if you like. We aim to continue to drive our prices down, killer pricing as a key differentiator, which will drive greater conversion, lower acquisition costs, higher retention dynamics. Because our cost structure is so advantaged, you already see in this quarter what happened to our LAE, which is already perhaps one of the very best in the industry when we are so subscale, gives you an indication of what our cost structure is going to look like already now. And as we scale, ability to accelerate growth while decreasing our underlying operating expenses, all of these are very strong indicators of our long-term ability to operate at a far, far lower cost structure than our competitors. And then you get a choice, which is do you then price similar to competition and increase your margins, or do you lower prices and accelerate growth? And for reasons that I elaborated at some length during our recent Investor Day, our bias is towards lowering prices, getting the conversion and the growth and the retention that brings until we get to sizable scale. So I would not guide or set the expectation that our loss ratio will continue down the trajectory that it has for many, many quarters. We've achieved healthy loss ratios. And at some point, lowering loss ratios more than that just means that we're not being as price competitive as we could be.
Super helpful. Thank you.
We have a follow-up from Jack at BMO. Jack, please go ahead.
Hey, thanks for taking the follow-up. Just one, I think there was like an 11.7 million tax refund benefit that you all had this quarter. Just any color on what that was and whether there's anything similar we should think about potentially reoccurring in future quarters.
Yeah, that's a one-time tax credit related to the ERC program, so that's not something we'd expect to reoccur.
Got it. Good. Thank you.
We also have a follow-up from Andrew at Jefferies. Andrew, please go ahead.
Hey, thanks. Tim, I think I heard you say earlier the leverage that you would be running to max is 6-to-1. Was that on a gross premium basis? And if so, could you provide that on a net as well?
So again, we don't necessarily guide to that. So that's just more of broad strokes of what our targets are. Yes, on a gross basis. Historically, we've talked about gross written premium in that 6-to-1 ratio. There's also a dynamic in the regulatory surplus that requires a 3-to-1 on a net basis, which comes into play depending on how the quota share reinsurance is structured and other sort of accounting dynamics. But again, I would think of those as substantially unchanged. 6-to-1 on a gross basis, if you directly translate that to net, you get something like 4-to-1 versus 3-to-1, but more or less, I would think of it all as unchanged.
Is that just on a U.S. entity basis, or is that including the Cayman captive?
All of that is on a consolidated basis. If you isolate the Cayman, the ratios are dramatically different. And that's part of sort of the benefit of these different structures is that all the regulators understand and analyze each other's requirements and approve of them, such that this is a pretty common structure. But if you isolate any of the entities and do some math, you're going to get different numbers. Everything that we communicate is, I would think of it as on a consolidated global basis for Lemonade Inc.
Okay, thank you.
Mm-hmm.
We have a follow-up from Katie at Autonomous. Katie, please go ahead.
Yeah, one more question from me on the non-renewal program and sort of the efforts to remix the homeowners book. Could you guys give us an update on, where exactly in that process you currently sit, how much more remixing needs to be done, or how much more of the book is still subject to non-renewal? And has the
change in the quota share structure sort of extended the potential timeline on that process. I guess what I'm really trying to get at is, when can we expect to see that ADR level increase north of 84% again?
Yeah, so I would think of the impact as being fairly steady. If you look at the back half of last year, the first half of this year, and the expected second half of this year, the run rate impact is more or less the same in each of those three segments. I would expect by the end of this year, we would be past the most significant part of it. I would not expect it to necessarily go to zero in the beginning of the following year, but I think the pace will certainly begin to diminish based on what we know now. This is obviously something you look at as the book evolves, but I think it will start to dissipate as you get out of the back half of this year. And that is not the only impact on the ADR number, but it is a more notable impact in this period. So I would expect the ADR to have the opposite dynamic, where it would continue to be stable and then start to tick upwards based on all of the other dynamics in ADR, customer retention and other improved dynamics. We noted the car loss ratio at renewal. I mean, those are the kinds of things that push that number up. So I'd expect that to be more visible as we come out of the back half of this year in the ADR number.
Maybe just to state the obvious, Katie, but in addition to dampening annual dollar retention numbers, this program also dampens our top line, our revenue and our in-force premium. We are really growing faster than the numbers that we reported would indicate, because we've also got this counter action of non-renewing part of the book, cleaning the book. So as Tim said, we'll get through the bulk of that by the end of this year, and then there will be, I think, something of an unleash not only of annual dollar retention metrics, but also a bit of a tailwind to our top line metrics as well. And of course, we're doing all of this in service of our bottom line metrics, which is we've always been pretty disciplined. As our data comes in and we get smarter about what we should and should not be underwriting, we decide to apply our new kind of insights retroactively wherever we can as well. And that's what you're seeing happening here. The fruits of that have already manifested several times. Our loss ratio is testament to that. Our Q1 loss ratio during the wildfires in California were very strong evidence of why this is all a price worth paying. But we do pay for it in a couple of currencies, ADR being one and top line metrics being another.
Thank you.
We have no further questions. This will conclude today's Q&A session and thus conclude today's call. Thank you very much for your attendance. You may now disconnect your lines.
All right, there we go, everyone. Lemonade's Q2 2025 earnings call is officially over. The market will open in about 30 minutes. And so far, things are looking pretty good. There was quite a bit of a pullback before the earnings call in pre-market. Glad I made a couple buys down here, where we were up only about 5%, but now we are up again almost 9% in the pre-market. We'll see where we open, but today should be pretty interesting because, as most of you guys know, Lemonade has a 30% short interest. So if there's any short squeezes on this double beat revenue guidance increase, then it could be pretty crazy. We definitely have not seen any short covering in pre-market. Normally, like if you're short and you're getting margin called on your short or something, that will happen during the actual open. But yeah, I'm a long-term investor. It'll be fun, obviously, to watch what the stock does today. But I'm holding this company because, I think I'm going to get 100x. But that's obviously not going to happen today. So this is just one exciting day in the next, 10 years, 20 years of the Lemonade story, as I think they're going to dominate this massive industry that's worth 8% of GDP. And if that happens, I mean, this could easily be a $1 trillion company. And that sounds crazy because it's only a $2.7 billion company right now. But it's really not crazy when you look at the total addressable market and you look at their execution. So I thought this was really interesting. So I didn't look at this prior to the call. I didn't scroll down this far to see this, but this is really, really nice to understand how the reduction in reinsurance is actually going to affect revenue. So previously, $1,000 of premium when 55% was reinsured, Lemonade could only claim $571 million of revenue off of this $1,000 of premium. Now, with quota share reinsurance dropping from 55% to 20%, $1,000 of premium 12 months from now, $844 of that is going to be claimable as revenue. So it is like a $230 $1 million impact, I think, over the next 12 months. It's going to add like 230. The math's not exactly right, but over $200 million it will add of additional revenue growth over the next 12 months on top of the normal, 30% IFP growth that we should see over the next 12 months. So overall, a really bullish call. I was super pleased with it. I wish there were way more questions about AI. As you guys could tell listening to that, no one from Wall Street cares about AI, I guess. They only care about what is going to directly impact my calculations for next quarter. And that's it. They're just like robots. I wish the whole discussion was about over the next decade, what is the in-force premium to employee number going to look like? At what point, is claims going to go from 55% automated to 80 or 90% automated? How quickly are you guys seeing the AI agents improve for different tasks? What different key performance indicators are you looking at to know whether or not your AI agents are getting trained in the right way? I would love to hear more about the fundamental stuff that actually matters. It's I don't care if growth loss ratio is 70% or 69% or 71% next quarter. It doesn't matter to me. What I care about is are they going to be able to continue this dynamic that they showed us right here, where operating expenses excluding growth spend has been decreasing for 3 years. Can that continue for a decade? How powerful is AI really going to be here? How transformative is this actually going to be over multiple decades? That's what I care about. But you're not going to get that from analyst calls, from Wall Street analyst calls, because like I said, they just care about predicting the next quarter correctly, because all their clients only care about the next quarter, because Wall Street professionals will get fired if they have a bad quarter of returns. So most people this is why long-term investing gives you such a big advantage. I am thinking out 10, 20 years. That means I'm alone. I'm not competing against anyone on Wall Street. Not a single Wall Street analyst is looking out 10 years or let alone 20 years into the future. So I am alone competing against no one. I liked some of the questions that we did get from retail. So Shai talked about how EU has lower catastrophic event exposure and easier regulatory environment, and EU grew 200% year over year. This is really big. This is so cool. Underwriting is improving really fast. 15% improvement compared to last year, 20 points better than the US at the same scale. Really, really exciting stuff. And then I also loved hearing about Loco. Loco is their AI kind of coding assistant, I guess, but it's far more than that as well. That helps them rapidly build new products, launch new regions, and experiment with dynamic experiences in hours instead of weeks without touching code. That's crazy. How come a single analyst didn't ask about that? Well, it's because they're financial analysts and they probably don't understand tech stuff at all. This is the same exact thing that happened with Tesla. All of Tesla's analysts were auto analysts, and they didn't understand what Elon was talking about with autonomy and FSD subscription revenue and robotics. And it wasn't until tech analysts started covering Tesla that we actually started getting half reasonable takes. So it's the same thing with Lemonade right now. It's all traditional insurance analysts that cover really boring insurance companies like Progressive and Allstate and these companies that have not innovated for 200 years. So all they care about is, is gross loss ratio going to be 70% or 69%? When what really matters is, okay, wait, what can Loco do in 2 hours instead of 2 weeks? Like how much faster are you going to be able to deploy in new states? How much quicker can you file all the regulatory documents? This is exciting stuff right here. And the call's not about any of why I'm invested in Lemonade. Yeah, the technology allows for expansion with low overhead. EU is going to be a key engine of rapid profitable growth. Bixby talked about a lot of the stuff that was just covered in the earnings that we went over. But then, yeah, the say questions were good. So, Paperbag asks if they were going to keep synthetic agents, and I thought the answer was great. Yes, they're keeping synthetic agents. Already confirmed for 2026. There is no reason for Lemonade not to use synthetic agents. Okay, the only reason that you might think they shouldn't use synthetic agents is you're like, we're giving another party, a couple percentage of the revenue for the first couple years. So if you're greedy, you might be like, we need all the revenue. But when you think about it, like Lemonade is a $1 billion annual premium company in an industry that does $7.5 trillion in annual premiums. There is such a big pie that it doesn't matter that we're giving up a couple percentage of the revenue to synthetic agents when it causes the internal rate of return to be 100% because it allows them to leverage their growth spend by 5x. So synthetic agents are staying, and I'm glad they're staying because 100% IRR, like guys, you are not going to find another company on the whole freaking stock market with 100% IRR on their growth spend. This is insane. It's insane that this company is trading for where it is trading. Renewal of synthetic agents will continue 26. Okay, and then this question was good. We got some more information about the expansion trajectory and how Loco allows the resources that Lemonade needs to expand quickly to be far less. But then this was like the only question we got about AI. We got one question about AI from Say, and that was it. And it was, is Lemonade ahead of all other AI companies? And this is probably the most important question that we got during the entire call. And the answer was yes. And this question was about, not only about, is Lemonade ahead, but can it stay ahead? And they said that they believe the gap between us, Lemonade, and incumbents is very likely to expand as AI accelerates. So Lemonade answered the question not only by saying, yes, we are really far ahead in AI compared to anyone else, and no one is even close, but they said they expect that their lead is only going to continue growing. And that makes sense if you understand rate of innovation. That's why Elon talks about how Tesla doesn't enforce their patents, because Elon says patents don't matter. What matters is rate of innovation. As long as you're innovating faster than other people, it doesn't matter if they're using old patents because you're already doing the next invention. And Lemonade is already innovating, but maybe a couple orders of magnitude faster, like 10 times or 100 times faster than legacy insurance companies are innovating. So it makes sense that if Lemonade has already been innovating faster and they are going to continue their rate of innovation, that their lead will only expand compared to incumbents. You have to remember, Lemonade's not competing against Amazon. It's not competing against Tesla. It's not competing against Google. It's not competing against companies that are 80% AI engineers. Lemonade is competing against legacy insurance companies that normally have no AI engineers. Most insurance companies buy third-party software. They don't build their own software. So how are they going to build an AI platform for trading AI to become an insurance superintelligence? They can't. Like, I was reading a big report on AI and insurance, and the insurance company outside of Lemonade with the most engineering talent had 3% of their employees had any amount of engineering talent. 97% of their employees had no engineering talent. And that was the incumbent with the most engineering talent. So yeah, the idea that Lemonade's AI lead is only going to expand, I think it's almost a certainty. Lemonade has a real data edge. So this is something that bears do not believe at all. Like most people will ignore this. And on X, you will see bears continue to say, Lemonade has less data than incumbents. How are they going to win in AI? It's just not true. Like, Lemonade is collecting so many more data points than legacy insurers that it's not even really worth comparing. Lemonade, with telematics, for example, for car, industry telematics is like 5%, less than 5% continuous telematics for the insurance industry as a whole. Lemonade has over 90% of their policies use continuous telematics. So Lemonade literally knows through the app in your phone as you're driving, what time you're driving, whether or not you're speeding, whether or not you're texting while driving. All of these data points then feed into Lemonade's AI platform and train the AI, allow the AI to adjust prices in real time. Like my policy, I got a Lemonade policy, I think 2 months ago, and the price has already been adjusted based off of my actual driving. So yeah, Lemonade does have a real data edge. Don't let bears fool you. And then on top of that, even if Geico has a crap ton of data, which they do, you know, when you have hundreds of systems, I forget the exact number, that are siloed and can't even talk to each other, then it doesn't matter if you have, you know, data at one facility that's not on the cloud and some data at another facility on another operating system that's also not on the cloud, because you cannot even feed this data into a single platform in order to use it to train AI. And they probably don't even know how to do that if they could get all the data on a single platform. Remember, Geico recently tried to upgrade to Amazon Web Services and they failed. So they're switching back to on-prem because they couldn't run their company on AWS because they're using too many antiquated old systems. So it wasn't efficient for them. So if Geico cannot even run on AWS, how are they, like, they're not going to build an AI superintelligence, guys. It's not going to happen. So yeah, they stand apart from incumbents with a single AI platform that uses data to feed and train AI. Only company in insurance that can fully capture AI's potential. I'll just tweet that out real quick. LMND is the only company in insurance that can fully capture AI's potential. And yeah, that's my biggest takeaway. It was a really great quarter. I was not expecting to see this actually decrease. That was crazy from Q1 to Q2 to see OpEx actually go down, excluding growth spend, was really impressive. And this trailing 12-month gross loss ratio at 70%, really impressive. And if Lemonade, as they said in the call, one of the questions was whether or not they're going to, you know, change the target range from 70% to the 60% range. And they responded no. Instead, they're probably going to focus on lowering prices more to increase conversion rate and just underprice incumbents even further. Lemonade is already cheaper than incumbents, and they are the most expensive compared to incumbents that they will ever be. Lemonade's advantage in AI growing also means their advantage in pricing will grow. And that means, like, already, I think I saved like 27% or something switching from Tesla insurance to Lemonade insurance. If Geico can build a multi-$100 billion business, I think it's over 100 billion Geico's worth. It's inside of Berkshire Hathaway, so it's a little bit hard to know. But if they can grow a $100 billion business with 15 minutes can save you 15% or more on car insurance, and Lemonade is already 27% cheaper than Tesla, which I think is like a top tier insurer, and that is just going to keep going down further. It's like, if you can save 40% switching to Lemonade, who's not going to switch to Lemonade? Everyone's going to switch to Lemonade. So I just think that their advantage is only growing. They have a fundamentally superior business model, and that is going to just mean good things over time. The growth rate is still accelerating. We're going to see not only IFP growth continue to accelerate year over year, but now we're about to see a rapid expansion in revenue growth rate as well. So overall, I mean, I would call that a 10 out of 10 quarter. And you know, like, last quarter was not 10 out of 10, right? We saw the California fires, trailing 12-month loss ratio was flat, and just that quarter was, you know, it was a bit high up here. This was a 10 out of 10 quarter in Q2, and Q3 is going to be the big one. Q3 is going to be the big one. Let me just end here. Let's go to Google Trends. We'll do this one last thing before we close out. By the way, if you guys have been enjoying, remember to drop a thumbs up and like this stream and retweet it out. Okay, let's do Lemonade car. And we're going to do this over 5 years. Lemonade renters. Lemonade pet. And, you know, we could even go out a bit further. We don't need to go out that far. But you can see the trend, right? It's going up and to the right. Google search for all of Lemonade's products are going up and to the right. And Q3, which is now the quarter that we've just entered, is normally Lemonade's biggest spending quarter on advertisement. So we are going to see I think we're going to see some great quarter over quarter growth going into Q3. But overall, over the next decade, this was a very thesis confirming quarter for me. And that's the big thing I care about. So now I am done with work as far as investing goes for the next 3 months. I'm partly kidding, but partly not. So thank you guys all so much for watching. Thank you for participating. This great reaction here. I was not expecting, you know, thousands of people to be watching live, but thank you guys all so much for joining. And I'll probably do this again next year. I mean, not next year, next quarter. So I will see you guys all on X. Make sure you guys are following me on X if you've not followed me already, at Jake Browatsky. I tweet about Lemonade all day, every day. And subscribe on YouTube if you've not already. It's youtube.com/howtoinvest or at howtoinvestjb. And yeah, you can see we're live here on YouTube as well. And I make videos here about a lot of different companies, and then I also have a couple of my siblings make videos here as well. I'm teaching them how to analyze stocks. My brother Aaron is helping run all of our calculations and models and stuff. So yeah, definitely check out our YouTube channel as well. And without further ado, everyone, thanks for watching. It should be an exciting trading day, and I will see you all on X.